you can identify the defensive characteristics of this broadening out, staples, utilities, beneficiaries of lower interest rates maybe, and then you can sort of identify the trash, so to speak. Some of the names that have sort of rallied on relief from what we've heard from Chairman Powell on Friday.
You called trash regional banks?
Not all of them, but sure, some of them, yeah.
Okay, so there's this issue of, okay, will anyone fail? Or will we essentially have the zombie companies that have survived until 25 that will be carried along by now lower rates going forward, right? And this is sort of the tension right now in markets. Are we entering a period of benign rate cuts or not? And essentially, we don't have an answer. It feels like analyzing oil policy is the same as analyzing Fed policy, which is the same as analyzing political policy, which is a black box that we cannot give you insight into. But it is a question right now of where markets are trying to find an edge. And right now, it seems like on the margins, using options to hedge NVIDIA seems to be the play that is rocking a very quiet market.
We'll have a long conversation about how defensive NVIDIA actually is. Look out for that conversation in just a moment. I want to talk about the calendar just briefly. Wednesday, NVIDIA earnings, and for many, that's when the week really begins. On Wednesday, after the close, NVIDIA results. And then on Thursday morning, for all of the Fed speak out there, no one's going to adjust their Fed call on NVIDIA. Maybe they will, I don't know, but ultimately they probably shouldn't. This will come down to jobless claims on Thursday morning, 8:30 Eastern time.
How bad is this economy? And that ultimately is the real question at a time where we saw Mary Daly reiterate yesterday with Michael McKee what we heard from Jay Powell, which is further weakening in the labor market is not welcome. They do not welcome further cooling. So what is the threshold for them to move in a more significant way? How far ahead of this do we get? You know, there's a tension right now, and there are two camps of analysts. There was one saying that more than 200 basis points of rate cuts through the end of next year implies really significant weakening. And then there are other people who say actually the neutral rate is low enough that 200 basis points of rate cuts will just get us down closer to neutral, but will still be restrictive. It is unclear to me which camp is going to win out because frankly, I still don't have a handle on just how much inflationary pressure is left in the system. And on the flip side, to jobless claims tomorrow, just how much weakness there is in a system where we haven't really seen it in the overall headline data.
Our survey's still coming together. 233,000 is the estimate for jobless claims in the last week. The previous week, the number was 232. And over the last 3 weeks before this one, we've had these reads that are pretty contained. Pretty contained. If you think about what spooked this market, unemployment going up just a little bit more and jobs coming in at 114. Now, 114 is not a terrible data point. We just got blessed by really, really big reads, which ultimately were revised a lot lower. So what is bad on September 6th? We keep going back to a question that might sound tedious, but I think we need to know the answer to that to sort of gauge what incoming information will do to this market in the weeks to come.
And nobody really has a full answer on it. When you ask people, they hedge and haw, and they say it's the totality of data, and it's going to be the internals, and it's not necessarily going to be one aspect or one headline number. There is an existential fear that you can feel in a lot of these Fed speakers as they talk, which is it never happens in a linear fashion. You never see unemployment just gently tick up and then end at 4.5% from 4.3%. There is usually a significant asymptotic rise in just how quickly the unemployment rate can rise. So if that's the case, they want to get ahead of that, and any kind of weakening that is below in terms of the jobs created, what people were expecting, could be considered just one data point on that increase in unemployment that people are fearing.
The change in the last 2 years has been amazing. We'd have people come on this program talking about a Federal Reserve concerned about its legacy. And when you think about policymakers in the risk management business and legacy, we mentioned this last week, they're concerned about what they don't want to be remembered by. Not what they do want to be remembered by, what they don't want to be remembered by. 2 years ago, they did not want to be remembered as the central bank that allowed inflation to get away from them in a repeat of what we saw in the 70s. 2 years later, you can feel the fear. The fear now is not inflation. The fear now is unemployment getting away from them, just after a little bit of a move higher over the last few months.
You talked about Jay Powell and the tone of his speech, and that it wasn't a victory lap, but it was him painting history. It was trying to say, my legacy is going to be the soft landing that we engineered that everybody said was not possible. And we are concerned of not being able to do that, not because of inflation, but because of where employment is. That is a shift in tactic that is important to note at a time where they're not willing to talk about whether they're flexible in that 2% inflation target. And that's going to come more into force, especially with these bond auctions.
Let's put it this way. The stock market heard it loud and clear. Never mind the bond auctions. This stock market heard it loud and clear. Coming up this hour, we'll catch up with Sebastian Page of T. Rowe Price on the bull versus bear debate, Matt Stuckey of Northwestern Mutual ahead of NVIDIA results, Oliver Chen of TD Cowen on key US consumer themes. We begin with our top story. Stock steady as traders await the next big catalyst, NVIDIA earnings tomorrow. Sebastian Page of T. Rowe Price writing the following. We're positioned for the market to broaden out over the next 6 to 18 months. We like value stocks and real asset equities. Seb joins us now for more. Seb, I'll go to your line. Aggressively, confidently, and with tons of conviction, neutral. Seb, has that changed after that speech on Friday from Chairman Powell?
It hasn't, Jonathan. We're still having the mother of all debates between the bulls and the bears. The bulls are being pragmatic and saying, look, earnings are growing 11% and rates are coming down. So those two things are pretty good for markets. And the bears are saying, well, the economy is slowing, and you can look at economic surprises indices, for example, or manufacturing PMIs going into the 47, 46 range, or the labor market. So the bears are concerned with the economy, and of course, Jonathan, they're concerned with high valuations. So what do? When you see both sides making compelling arguments, you know that over time, stocks and bonds will deliver a return. And I'm adding bonds to that statement because we're getting into a rate cutting cycles. So you stay fully invested in your stocks and your bonds at a risk level that matches your long-term risk tolerance. And so if you, it's not exciting. If you want to make it exciting, you say you're aggressively neutral.
Sebastian Page of T. Rowe Price, thank you. Looking forward to catching up with you next time. Leave it there. Come on, Seb, give me more than that. When you sit there and you hear the argument from the bulls and the argument from the bears, who wins out in your mind? Who has the most convincing argument at the moment?
John, you scared me. I thought I was getting thrown off the air right away. Look,
The hook.
Here's how I think about the stocks versus bonds debate. You have to have more conviction to be bearish than to be bullish. Over time, stocks outperform bonds, if you go back to 1940, by 7.3% with a hit rate of 70%. So when you're in that situation, the base case, the base rate, which is really important in forecasting, matters. So if you force me to take a position, I'm going to say, you know, I'm going to hold stocks in this environment. Look, I don't think we're getting into a recession. You have a lot of guests over the last few days saying we're slowing down, but it's not a recession. I'm in that camp, Jonathan.
If that's the case, Sebastian, why own so much cash?
Yeah, this is a great question, Lisa, and we're looking to add to bonds in this environment. We just did a study of 12 Fed cutting cycles over 70 years. This is an important regime shift we're getting into. We're getting into a cutting cycle. Now, disclaimer, this one is not exactly like any cutting cycles in history. In particular, usually the Fed starts to cut when recession probabilities spike. And right now, consensus, they're at 25%. So it's a pretty good environment, nonetheless, for the Fed to cut. Okay, setting that disclaimer aside, 12 out of 12 cutting cycles, bonds outperform cash. And they outperform cash by a remarkable average of 8%. So we're looking to add duration. It's a bit uncomfortable right now because bonds have rallied so much. But we're looking to, over time, phase in some duration, start deploying some of that cash into bonds. And you don't want to be too sensitive to the entry point. So maybe you do it by the dip, but in bonds, or you just phase it with some discipline over time. So that's what we're looking at right now, deploying that cash into diversified bonds. And the kicker is that, as everybody's been saying on your show, if growth is now more of a concern than inflation, then that's good for bonds as diversifiers. They start playing their role in the portfolio that we know and love for bonds. And by the way, they did pretty well with that /shock. Bonds acted indeed as diversifiers.
You know, it's a moment of aggressive neutralness, which is a really dramatic and important distinction from just, Neutral. But there is this question here going forward about just what rate cuts will do for stocks, in particular some of the high flyers, in terms of big tech. You are one who believes in broadening out in the equity markets, but there's a real key question, and we've been talking about it throughout the morning, about whether this is simply just looking at some of the less loved stocks and trying to diversify some of the holdings, or some real belief in true growth. Do you think that rate cuts will actually disproportionately help those companies that are smaller or less loved? Or do you think that maybe this is something that's going to help the big tech just as much in terms of valuation increases? It's just that the valuations have already gone up to the degree that they have.
I think it's the latter, Lisa. The big tech has been fully valued. Look, we still like a lot of these companies, and our stock pickers are really into some of the big tech. But as asset allocators, we are positioned for the broadening. Now, this morning, you're talking a lot about small caps. I like value better for the market broadening in this rate cutting cycle, where we don't necessarily get a recession over the next 12 months. Value stocks have a higher return on equity than small stocks. You're talking about like 13% average return on equity versus 3%. So what I'd rather do is neutralize small versus large and let the stock pickers look at opportunities for higher quality small and mid caps, but neutralize at the asset allocation level, and then go long value. Because look, by the end of the year, this is maybe not very well understood. The year-over-year earnings growth for the value stocks is expected to outpace the year-over-year earnings growth for the growth stocks, because the comparables are so advantageous for value stocks. I also think the election could be somewhat inflationary. You had someone earlier today talk about commodities. You know, I think with the inflation swaps at 1.9, 1.8%, there's room for inflation to surprise on the upside, in which case you'll be glad you're in energy sectors and value stocks.
So, Seb, when you say real asset equities, can you just build on that? What are real asset equities?
So that's a combination of energy stocks, of infrastructure, it's broadly diversified. It has also real estate and metals and commodities. So it's an inflation hedge. The reason why I like it more than tips, for example, it goes back to my earlier statement, like over time, stocks beat bonds, 70% of every rolling 12-month period. So I like to have stocks that have a highly levered response to unexpected inflation. Now, you might say, look, inflation's coming down. Why would you be long real asset stocks? I like to be long real asset stocks because I think the market is just pricing in such a smooth decline and stabilization and inflation that there's a lot of room for surprises. I'm not saying we're going back to 5-6% inflation at all. I'm just saying I like that hedge because a lot can happen, especially in commodities markets.
This was great. I'm pleased we took it a few questions longer. Let's catch up soon. Sebastian Page of T. Rowe Price. Sebastian, thank you. That last point got your attention, didn't it? Real asset equities?
I'm just thinking, okay, on one hand, you don't think that inflation is going to be a problem, which is the reason why you're increasing your exposure to duration. On the other hand, you are trying to go into real assets as a hedge. It strikes me this morning, and I go back to this point, I wrote it down because it really kind of represented how I feel today. Analyzing oil policy is the same as analyzing Fed policy, which is the same as analyzing political policy, which is we don't know anything. And we just basically are shooting darts at a dartboard. And so how do you diversify? And that's increasingly the discussion that people are having. What is the best way to diversify investments to try to hedge against all the potential ramifications of which none we know?
We talk all the time as if we're in the crystal ball business. What's the future? We're the risk management business.
Correct.
We all are. And that's what you heard from Seb there, right?
Right. Basically, how do you sort of offset these risks while also not underperforming from a historical perspective? And it's a really wise way to look at it. And I like the risk management point because there are a lot of unknowns, especially at this moment.
Equity futures on the S&P just about unchanged. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's your Hara Hackers.
Hi, John. National Security Advisor Jake Sullivan has arrived in Beijing. His three-day visit is his first to China as President Joe Biden's top national security aide. He plans to meet with Foreign Minister Wang Yi and raise concerns over China's support for Russia in the Ukraine war, plus Taiwan and the South China Sea. While China is likely to bring up Taiwan as well, along with U.S. tariffs and efforts to cut China off from advanced technology. Apple has sent out invitations for a product launch event on September 9th, where it's expected to announce details of the iPhone 16. The theme of the event, It's Glow Time, is a reference to the interface used by the new Siri digital assistant. Meanwhile, Apple says longtime CFO Luca Maestri will step down at the end of the year as part of a planned succession. He will hand the role to his top deputy, Kevin Parekh. And Eli Lilly is selling its blockbuster weight loss drug Zepbound to patients at about half of the cost of its widely popular shots. Patients with a prescription can purchase a month's supply of single-use vials through Lilly's direct-to-consumer site starting today for as little as $399 a month. A higher dose is going for $549 a month. The move is part of Lilly's all-hands-on-deck effort to expand access and ramp up supply of Zepbound and a similar drug for diabetes amid widespread shortages. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. More for real news. Some real news. Oasis back together. Back together. Liam Gallagher out on X 3 hours ago. The guns have fallen silent, Bramo. The stars have aligned. The great wait is over. Come see. It will not be televised. Summer tour next year.
I can just imagine.
You in?
Yeah, I think so. I think that I also need about 3 hours of sleep to come in one day and feel really up to talking about
I'll tell you a story.
scintillating market.
It's a good one. We've got a couple of minutes, all right? TK comes to me one day, doing the radio show together. This is years ago. And they say we can play music going out to commercial breaks. So I'm like, cool, great.
Yeah.
So I picked some tracks from that album that came out 30 years ago.
Yeah.
What's the Story, Morning Glory, all right? I never hear them. Why? TK comes back into work and gets my takes of Oasis that we're using to bump into commercial breaks and gets them erased off the system to make sure they're never played. Hates
Why?
the band, can't stand the band.
Why?
Wouldn't play my music.
Coming up next.
Wanted like 70s rock.
Coming next, Tom Keane on why he doesn't like Oasis,
So we went
why
into
he
a room,
hates
we had
quality.
a big fight over it, and that was it. The end of music, going to commercial breaks. We couldn't do it anymore.
That's absolutely hilarious.
Got them erased
No
off
more
the
joy.
system. No more joy.
Disagreements?
TK
The
banning
end.
joy on radio. Up next on the program, managing US-China relations.
There is no question that the Trump administration started with tariffs, and the tariffs under Biden are higher and more exhaustive now than they were under Donald Trump. I don't see any scenario where any of these tariffs come off once they get put on.
That conversation up next from New York. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Equity futures on the S&P negative by 0.05%. In the bond market, yields higher by 3 basis points. The 10-year 384.63. Under surveillance this morning, managing U.S.-China tensions.
There is no question that the Trump administration started with tariffs, and the tariffs under Biden are higher and more exhaustive now than they were under Donald Trump. The USTR, the Department of Commerce, all the investment restrictions, export control restrictions are only growing. I don't see any scenario where any of these tariffs come off once they get put on.
Here's the latest. U.S. National Security Advisor Jake Sullivan visiting Beijing for wide-ranging talks with Chinese officials, expected to raise the issue of tariffs, the nation facing new tariffs from Canada as the country lines up behind the United States with a 100% levy on electric cars with 25% tariffs on steel and aluminum. Bloomberg's Mike Shepard joins us now for more. Shep, that's the purpose of the trip. What's the prospect that we get any real results from the trip?
Well, look, the real result in this, if you're looking at it from the Biden administration's standpoint, is to really keep things from getting worse than they are. And let's be frank, relations with the second largest economy are not great right now. We've heard the litany of things that have been imposed by the U.S. and by other governments against China when it comes to its economy, when it comes to electric vehicles, and all of those things are really weighing on the relationship, and especially because we're also seeing a softening in the Chinese economy. We saw some signs of malaise in China's economy among Chinese consumers today when Timu's parent, PDD Holdings, gave a gloomier outlook than had been expected by investors. And while it's not connected directly to Jake Sullivan's visit to Beijing, it is certainly overshadowing it, and it is one of the things that is driving Chinese officials' concerns. They're watching their own economy at home and anything that might be affecting it.
Shep, we spent a lot of time talking about the prospect of more tariffs coming from the former President Donald Trump. You heard the words there from Henrietta Trace of Vader Partners, who said there is no question that the Trump admin started with tariffs, and the tariffs under Biden are higher and more exhaustive now than they were under Donald Trump. Do you think we've read this story wrong? What can we expect from Harris?
Well, we're not seeing any signals that Harris is going to take her foot off the gas if she's elected president and her administration takes office in January. Everything that they have signaled so far is a continuing tough stance on China. Now, what they are looking for from China is certain benchmarks in terms of how their economy is behaving. One of the biggest concerns, for example, is with electric vehicles, and this is one that's shared by other allied governments, from the European Union to Prime Minister Justin Trudeau's government in Canada, is that China has been supporting unfairly its domestic electric vehicle industry to an extent that it puts manufacturers in other countries at a disadvantage. And this is something that Harris has been emphasizing, the Biden administration has been emphasizing, so we should not be looking for any change to that, nor to the regime of export controls that the Biden administration has been imposing on a wide range of advanced technologies, especially those that are used to produce semiconductors. And that is something that we can look to continue.
Mike, just quickly, I've got a minute here. What's the real reason that Jake Sullivan's going now? I mean, the timing is a little bit strange to be talking about this ahead of the election amid a number of hot wars. Is it really about the tariffs, or is there another agenda?
Well, really, the goal is to make sure that relations are locked in and stable as we head into this election. They want to make sure that this relationship that the U.S. has tried to forge, staying tough on China while also staying engaged, doesn't get any worse, and that they're able to lock that in so that it lasts and it withstands whatever happens in the election in November.
Shep, appreciate your time, sir. Mike Shepard there out of D.C. on the latest between the United States and China. You asked that question because you've got something in mind. What do you think it is?
I just wonder, what kind of clout does Jake Sullivan bring under Biden right now, given the fact that Biden is not running again? So what is the goal of this? Is it really going to be to try to pressure Russia with respect to Russia and Ukraine? What Mike said there I thought was really important, which is essentially they don't want any surprises ahead of the election. They don't want anything to derail what could potentially come down the pike ahead of that key November day?
There's a few reasons you use tariffs. One is just lack of reciprocity. That was the beginning of all of this. Another is national security. You've heard that repeatedly. The other would be leverage. They've failed to use this as a point of leverage. Big, big failure. More on that still to come. This is Bloomberg.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
Was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Live from New York, welcome to the program. Stocks on the S&P 500 shaping up as follows. We look a little something like this, slightly softer by 0.04%. The NASDAQ 100 got hit hard yesterday, down by more than 1 full percentage point. And the outperformance, we've mentioned this a few times already this morning, on the Russell, on the small caps, just about unchanged yesterday at the close. And Lisa, this morning, just about unchanged as well.
Yeah, here's a question that I have, and we've been talking about this all morning, and I'm really excited to speak to our next guest because he's got an interesting insight into this. But essentially, how much is the outperformance of everything other than big tech just simply the fact that it has a lot more to catch up? The idea that if you own NVIDIA, congratulations. If you are underweight them, you are lagging behind by probably more than 400 basis points the S&P 500 target. So that really is the dynamic that's underpinning maybe some of what we've seen over the past couple of weeks.
You've got some catching up to do into year end. That's the equity story. switch up the board, turn the page and get to the bond market. I'll talk about some supply for you, just for Lisa.
Thank you.
2-year notes coming later, $28 billion worth tomorrow, $70 billion worth of 5-year notes after that, $44 billion of 7-year notes. How much of a test is this, given how quiet things are?
I mean, do you want the real answer or do you want the exciting answer?
I don't want the Bramo exciting answer. I want the real answer.
Okay, well, look, the 2-year I'm not that excited about. I'm going to be honest. 1 p.m. is probably going to be pretty solid. Watch it now be really exciting. 5-year, maybe a little bit more so. I'm curious whether people start to move away from that because it's been an overweight for a lot of people. We heard that from Mike Collins yesterday. 7 years where I'm focused. I want to understand how much people are, foreign buyers in particular, are not buying U.S. Treasuries anymore, especially if you're talking about the possibility of a Federal Reserve that's trying to get ahead of any kind of downturn. Does this mean that longer term you're going to see higher inflation and higher benchmark rates? I mean, these are some of the questions that people have going forward that I think will make the 7-year more interesting.
It makes me think of that Stephen Jen argument that we've been talking about here at Bloomberg. And thanks to the team over in London for writing up this story. Chinese companies may be enticed to sell a $1 trillion pile of dollar-denominated assets as the US cuts interest rates. This is Stephen Jen. He says that could mean a move in the yuan by up to 10%. Think of an avalanche. That's what Jen's got to say. This is like, really, really big, beefy call. We've talked a lot about Japan and the dynamic coming out of Japan. Not so much with regards to China.
You can understand the logic, especially with the twin deficit issue that the U.S. has with China, as well as the just flat-out deficit of the United States and how much it's increasing. Whether it's actually put into practice, though, is another story. You can come up with a theory about why longer-term yields should be a lot higher, and then that theory gets dashed in practice again and again. If you start to see true money moving out of the longer end of the U.S. yield curve, could that begin that avalanche process? Maybe. I don't expect that to be this week, but those are the reasons why I keep watching these auctions very closely.
Every single time they come, as you should. That's the bond market and foreign exchange. I want to finish on the commodity market. A couple of calls we've had from Morgan Stanley and Goldman, just some revisions around oil price targets. The latest from Goldman, reducing their range for Brent by $5 to 70 to 85, a new average price target for 2025. The average forecast for Brent now 77 versus 82 previously. They say this reflects upside surprises to OECD inventories, amongst other things. And there was this last line that we picked up on that I think it's worth talking about a little bit more, Lisa. We still assume that OPEC will raise production in Q4 as the market is potentially shifting from an equilibrium where OPEC supports spot balances and reduces volatility to something new. And this something new is a more long-run equilibrium focused on strategically disciplining non-OPEC supply and supporting cohesion.
Strategically disciplining non-OPEC supply, to me, screamed, hey, shale patch, stop producing so much and thinking that you can just do this in an unchecked manner while we try to be disciplined and coordinated in how much we produce. That has been the swing factor in how much they're going to try to maybe reduce some of the profitability of U.S. energy producers, oil producers, by increasing production a bit to lower prices. What is that target price that OPEC Plus is looking for that could potentially give them the profits they're looking for, while also not delivering overly to the U.S. producers?
3-day rally coming to an end on crude. Brent down by 0.4, $81 and about 10 cents. Under surveillance this morning, some top stories for you. Meta CEO Mark Zuckerberg saying Facebook was pressured by the U.S. government to censor content related to COVID-19 during the pandemic. In a letter to the U.S. House of Representatives, Zuckerberg saying he regrets giving in to the demands. It's starting to sound like a little bit of an apology tour to the other side of Washington, isn't it, over the last few weeks?
That's exactly where I was going to go with this. Why now? Who is this for? Who is the audience for this? Is this basically hedging his bets in case Donald Trump comes back into office? Is this being provoked by something else? It's a real question at a time where there was a lot of time for him to talk about this. Now is the moment that he's choosing. It's also interesting in light of the arrest of the Telegram in France,
yeah.
the founder there. There's a lot going on. I'm just curious about what he's trying to get ahead of to sort of argue for free speech and try to get ahead of certain policy shifts.
The tour started sitting down with Bloomberg's Emily Chang. He called the attempted assassination the most badass thing he's ever seen. He also said that he wouldn't be donating to any political parties this time around. You can just see him distancing himself from some of these issues over the last couple of years.
Yeah, saying that Trump was badass in his response to the whole thing and sort of, how much is this trying to curry favor with both sides? And how much is this a true shift in his stance in terms of arguing for free speech and a reluctance to really work with the government without putting up more of a fight, because they did come under a lot of pressure and it did reduce their credibility.
That's the latest on Meta. Here's the latest on SpaceX. Delaying the launch of a rocket carrying 4 private astronauts to space due to a helium leak. The goal of the mission, called Polaris Dawn, is to perform the world's first commercial spacewalk. The next launch window is set for tomorrow morning. Of course, SpaceX in the spotlight at the moment because they're bailing out Boeing in a major way, potentially, in the next few months.
Bailing out or replacing is sort of going to be a key question going forward if Boeing decides to discontinue their space program. To me, this also raises this question of, okay, how many billionaires are there out there who will pay for a spacewalk? I mean, is this sort of the next frontier? I can imagine, you know, my boys grow up. I think that they ever have that kind of money, that's probably what they would do. And they get to wear really cool spacesuits that I spent a lot of time focusing on yesterday.
This venture's less about tourism, though, right?
This
venture,
a
real sort of like commercial business purpose to what he's trying to achieve here.
Yeah, well, I mean, this is part of it. There's also this issue of how much are they going to be pairing with NASA, but really the commercial aspect is a big question mark. What is the ultimate goal? We don't know.
We'll work it out slowly. I still can't believe there's people stuck in space and it's not the top story every night in this country.
Do you know the guy has 2 kids, 2 daughters?
How many people know the names of these people?
I mean, that's, I was looking up. Well, if you want to know, it's Barry Wilmore.
Thank you.
And Sunita Williams. They're stuck in space.
It's like a total failure of media coverage. If this was the 60s or the 70s, can you imagine every night there'd be like day 65, stuck in space?
I think we should bring that.
You'd have interviews with the family members. It would go on and on and on. Be a top story in this country.
This is an open invitation.
But what does that tell you? Is this faith in SpaceX and Elon Musk just to sort it out? Is that what this is? Is that why you don't get that much attention on this story?
This is just simply a law of numbers, that there have been so many people who have gone up into space that it's almost considered humdrum or quotidian. I mean, that's sort of more than, say, the 1960s.
Can you imagine how humdrum people think going to space for a few days and coming back 6 months later might be for the people up there? Like, it's a nuts story. Yeah, anyway, all right.
Good movie.
Let's talk about NVIDIA. NVIDIA tomorrow, results due out after the closing bell. Expectations are really high, with analysts anticipating another strong beat that could prompt the chip maker to raise its profit guidance. Matt Stuckey of Northwestern Mutual writing the following: there's a risk that the guidance doesn't meet rising expectations. NVIDIA has been the driving force of positive earnings revisions to the S&P 500 for the last year and a half. AI needs to continue to be an area of investment and ultimately ROI for these trends to continue. Matt joins us now for more. Matt, it's good to see you. Thanks for your patience, because we've got a lot to talk about. Let's just take a big step back and think about the return contribution of NVIDIA to the overall market over the last 18 months. Has this been unsellable? Is it still unsellable for a lot of people you speak to?
I think it is still one of those areas that some portfolio managers are afraid to step into now because they feel like they've missed out on the move. What's so unique about NVIDIA is that if you rewind the clock just a year ago and looked at what they were expected to earn in 2025, it was around $1.50 per share on a split-adjusted basis. Today, it's around $4 a share. And so we've seen just the fundamentals accelerate in such a unique way for this company that it's caught a lot of portfolio managers just simply off guard. And like you said earlier, if you didn't have this in your portfolio, you're immediately behind the 8 ball as it relates to the market benchmark by 400 basis points. And so it's a really, really challenging stock for portfolio managers to get their head around.
Can you just frame the risk event that is tomorrow afternoon? How big a risk is this, and how is it priced?
Well, looking at the implied move, it's fairly average for NVIDIA. It's about a 10% stock reaction, plus or minus. If you were to go back a few weeks into NVIDIA's price action, the stock was trading south of $100 a share. I would say the setup there is pretty bullish into the print, but now we've rallied about 30% or so. And so you're looking at more of a balance there between upside and downside. And the key here is probably Blackwell commentary for their new systems, which are scheduled to start to really ramp up production in the January quarter and into 2025, really carry the momentum for NVIDIA. I think some of the concern about, some of the ongoing kind of manufacturing complexities with this is causing some consternation, whether or not they're going to be able to hit that ramp up in production. And so commentary during the earnings call might change the direction of the stock reaction. And so it's going to be really important to tune in, not just to the earnings report and guidance, but also tune into the call to see how that production ramp is tuning up.
You said it's about average, a 10% move. But let's put that into market cap perspective, considering how much the stock has rallied over the past year, so far this year, 150%, I believe, so far in 2024. That means that would be a decline or an increase of $310 billion of market cap. That is 2 Disneys. We're talking about a lot of money that gets moved around with just what is an average move on a day of earnings for NVIDIA. Where does that money go? Does this create a risk-off feeling broadly, or is this something that gets transferred into some of the less loved stocks?
Well, it's over 6% of the S&P's market cap in terms of its index weight, and so it's increasingly a bigger component of kind of where the trend and momentum of the market goes. Revisions are a powerful thing. We talked about how the expectation for 2025 earnings have risen more than 150% year over year. If that were to continue, that takes away some of the underlying positive factor revision for the overall market, just given its weight and how much the fundamentals have accelerated for NVIDIA.
Does it talk then to the broadening out? Does that kill the broadening out, or does it fuel it? I guess, is it considered something of a risk-off moment more broadly for other stocks, or is this actually something that gives people the ammunition to diversify in a more significant way?
I think if you look at the market and you take away the Mag 7, what are the fundamentals looking like year to date? So earnings revisions there have actually come down about 7% year to date, not flat like the whole market is. So if you take out NVIDIA, you take away some of that fundamental support to the earnings guidance for the S&P 500. And so to me, I think it's more of a risk-off environment, like you said, not necessarily fuel for rotation.
Matt, lots of people would talk about the secular growth story that underpins this stock. How would this stock behave in an economic downturn? How defensive is a name like this?
Well, NVIDIA is high quality in the form that it has some of the highest margins in the world for a company. It's also high growth, but it's not defensive. The beta of the stock is 1.7, so it's not where you go for kind of sheltering up if the macro were to roll over into kind of economic contraction zone. That's kind of more utility, healthcare, that kind of environment. It's not NVIDIA.
Do you think that makes sense? Is that the way it should be? Is there a disconnect there that you think that we can explore?
I think given the amount of derivatives attached to NVIDIA, the options market and how much gamma is in that space, it makes sense to me. If you have a longer-term time horizon where you're looking out 3-4 years and the earnings growth and the story for NVIDIA continues, it does become more of a secular growth kind of area for portfolio managers to focus in on.
Matt, this was great. Appreciate it. Some fantastic work. Matt Stuckey there of Northwestern Mutual. Just a programming note, this is one not to miss. Tune into Bloomberg Technology. Special coverage tomorrow, 6:30 Eastern Time, an exclusive conversation with NVIDIA CEO Jensen Huang. Do not miss that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckers.
Hi, John. Wall Street is starting to sour on the outlook for crude next year. Goldman Sachs and Morgan Stanley lowering their price forecast. They now expect Brent to average less than $80 a barrel in 2025. The banks expect the crude market will be in surplus with prices trending lower over the next year. Oil is pulling back today after a 3-day rally. Meanwhile, Donald Trump is already thinking about who he'd put in his cabinet if elected to a second term in the White House. Trump saying he would ask Tesla CEO Elon Musk to serve as a federal cost-cutting consultant, but noting the billionaire might not have time. Trump also said Musk could give some very good ideas on things like AI. Musk endorsed Trump last month and created a super PAC to support his re-election effort. And British rock band Oasis has announced a 2025 reunion tour, ending a 15-year hiatus and seemingly a feud between brothers Noel and Liam Gallagher. The band posting on X, quote, "This is it, this is happening," and hinting at past tensions, saying, quote, "The guns have fallen silent, come see, it will not be televised." The announcement includes 15 shows across the UK next July and August. Oasis split up in 2009 after years of infighting. Both brothers went on to start solo music careers, and fans speculated for years about a possible reunion, and they got one. That's your Bloomberg Brief. John?
Yahara, thank you. Tickets on sale 9 a.m. UK time, Saturday, the 31st of August.
Today is going to be the day that they're going to throw it back to you.
Nice. Nice.
By now, you should have somehow realized what you got to do.
Yeah.
Which is buy tickets.
Of course.
That was good, right?
That's great. Thanks for reading the lyrics. Appreciate that. Good. Throwback, Bramo. Up next on the program, the selective consumer.
customers still a little bit squeezed by inflation. That has not gone in the opposite direction. From those discretionary spending companies, you want to hear that consumers are still looking for ways to continue their spending.
Oliver Chen, up next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City, welcome to the program. Equity futures right now, just about in the green, just about. Let's call it unchanged on the S&P 500. In the bond market, lots of supply coming through the week, kicking it off today at the front end of the curve with the 2-year, tomorrow the 5-year, after that the 7-year maturity. The 10-year at the moment, yields creeping high by 3 basis points, 384.82. Under surveillance this morning, the selective consumer.
We've got a lot of information coming about the consumer. We've already heard from some of those big box retailers, and their results have been positive, a theme that seems to continue as long as retailers are providing value to customers. Obviously, customers still a little bit squeezed by inflation. That has not gone in the opposite direction. From those discretionary spending companies, you want to hear that consumers are still looking for ways to continue their spending.
Here's the latest. The consumer front and center as retail earnings continue to roll out this week, with Nordstrom reporting second quarter results after the market closed today. Oliver Chen of TD Cowen remaining cautious on department stores, writing the following: bifurcation is growing across income cohorts as the lower income consumer is feeling pressure from high interest rates and high prices for items while continuing to look for value. Oliver joins us now for more. Oliver, always great to catch up with you, sir. Fantastic to get your thoughts on a consumer, so let's get into it. I want to talk about a bit of a disconnect at the moment that we found difficult to reconcile. For the likes of Walmart and Target, they're saying things are okay with the consumer. For other organizations, they say things are difficult. You say there's a more choiceful consumer, that we need to cut prices. You see that in the restaurant industry a lot. Oliver, what explains that disconnect at the moment?
Yeah, John, great to be here. The consumer is willing and able to spend, but they're being very selective about how they spend, and they're not ready. They're ready in different places. So there's market share winners and losers. And what we've seen so far is a negative 4% comp at Macy's, but a positive 4% comp at Walmart. So a real disparity. We are seeing green shoots. So we're encouraged that apparel was plus 3% at Target. It's also been trending nicely at BJ's and Costco. And Walmart is seeing better, flat discretionary trends, which is much better than negative. So things are moving in a better direction, but there's winners and losers. I would say department stores are in a tough place because they still need to appeal to younger consumers, and they're also facing ongoing share losses from the off-price sector. On the other hand, a retailer like Walmart has both needs and wants, meaning it has food and discretionary items. That is a winning combination in this market where there's lots of cross currents and the consumer is feeling pinched, specifically dairy prices, egg, food, as well as higher interest rates is leading to consumer confidence being very volatile. So it really is very mixed.
You've explored the consumer discretionary recession in different parts of the world as well. I want to talk about the geographic differentiation as well. China is a hole that some companies based in the United States are stuck in and maybe can't get out of for quite a while. Oliver, what names are suffering from exposure to China, and what names are you looking to avoid?
Yeah, John, unfortunately, luxury goods is in a tougher spot now with, as you know, China and the property market and valuations and consumer sentiment. Traffic's been tougher. So we've been watching the turnaround at Gucci. It's been cautious at Kering, and traffic as well as that repositioning of the Gucci brand is still something that's happening and we're cautious on. We're more positive on Louis Vuitton, LVMH, and the bargaining power they have and the leverage they have in terms of price increases and the $10 billion of marketing they spend. So we are recommending LVMH. We're more cautious on Kering. Overall, China and the China issues will continue to weigh on that consumer for the foreseeable future because housing valuations may not turn around for a while, and we're hopeful that the consumer will still spend, but the consumer there could save. That will cause more problems as well.
You talk, Oliver, about the winners and the losers, and you talk about it with respect to luxury, but just in general, in certain retail brands, you see this, for example, with Adidas and Nike losing share to the likes of OnCloud or Hoka. How much are you seeing a certain recipe that is becoming a trend for the winners versus the losers?
Yeah, Lisa, the barriers to entry are lower than they've ever been before. So new, smaller brands can innovate and launch and captivate the consumer. Also, this direct-to-consumer relationship with consumers is important as well. So I think the barriers to entry coming down is really testing larger brands where new brands can grow quickly and take traction. And new, younger customers, it's in many ways a zero loyalty customer. And with the advent of social media and things going viral, that's also helping emerging and new brands develop as well. So we'll continue to see larger companies really needing to rethink growth. We're seeing this across beauty, across sport, across technology. We'll continue to see AI be important, and we'll continue to see M&A be important, as well as consolidation to a certain extent as well.
This brings us to Lululemon earnings, which come Thursday after the bell, and this comes at a time that people are starting to diversify their athleisure clothing outside of Lululemon when it was the only game in town for a number of years. What are you expecting there, considering some of the competitors that I know that John and myself have noted yesterday? I won't go into them extensively today unless we get there, but I'm just curious, do you expect this to sort of be represented, the idea that there are other entrants that are truly being competitive right now with the likes of Lulu?
Yeah, the market has structurally moved in terms of comfort and performance. At Target, we saw very strong performance apparel. So thinking about stretch, four-way, thinking about the versatility and fabric technology, competitors have naturally entered this space in terms of being alternatives because it's attractive and it's structurally where the consumer is moving. So we'll continue to see that. That being said, Lululemon's a category creator. My colleague John Kernan covers it, and there's a global story too there, but this exposure to China at large for many companies is going to be a cautious, optimistic scenario in terms of that general environment that we're seeing.
Oliver, do you think Vuori's going public anytime soon?
Well, Vuori raised a lot of capital, and going public will be a key to growth at large from many companies. So we'll see. That being said, as you know, the equity markets have been tougher in terms of the IPO window and valuation, but lots of vibrant structural growth there. So part of that depends on the speed at which a company wants to expand globally.
Oliver, what is it about those brands, the Vuoris of this world, that are putting the squeeze on Lulu? What are they doing that Lululemon's lost?
It really comes down to fabric and innovation and newness and fit and how a brand's positioned. And also we're moving very, very quickly with Shein and the nature of ultra fast fashion and speed. So as we think about a class I teach at Columbia is called Magic and Logic. It's about supply chain speed and agility, but it's also about the magic and the emotions of the product being special and differentiated in the marketplace. Many wardrobes will structurally move towards performance. So the whole market is really focused on this in terms of clothing, adding comfort, adding that lifestyle, that wellness component, and that's part of performance, active, meets sport, meets clothes.
Next time you teach that class, we want to come, Oliver. Appreciate it. Thank you, sir.
Delighted to have you.
Thank you. Oliver Chen of TD Cowen. That's where the market's at right now.
Yeah, magic. Actually, you know, he mentioned also AI, and I wonder how much this magic is represented in social media posts that are AI-generated people who look absolutely fantastic
That
and
class
healthy.
must be packed.
I love that.
Isn't that great?
But it's true, and especially if the barrier to entry is that much lower, how easily can you create the magic with sort of viral posts that make their way around? It sort of raises this question about what new advertising looks like and how quickly things can adapt, and then the supply chain on the back end. I think that would be a fascinating class.
Yeah, you should drop by.
I will.
All right.
I'll take next week
We'll
off.
take the show. Coming up on the program, Phil Camporelli of JP Morgan, Bert Subin of Stifel, Seth Carpenter of Morgan Stanley, and Eric Nelson of Wells Fargo. The third hour of Bloomberg Surveillance. Up next.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
A Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
My baseline is that the Fed cuts by 25 basis points.
I think they'll go fairly slowly and feel their way along.
I'm kind of discounting the probability of 50 basis point cuts at this point. It's going to take a little bit more weakness or materially more to push the Fed to 50.
They're probably going to start in September with 25, but I really hope they ramp up the pace to 50s.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
This is what summer was supposed to look like. This screen right here. Equity futures going nowhere. It's meant to be calm. Stocks not doing much. No big events, no political changes, no big central bank pivots. Just stocks not doing much, so you can sit at the beach and just wait it out until after Labor Day weekend. This is not the summer we've had, Lisa. This is not the summer we've had at all.
Wait, sorry, you want me to stay? Like, this is not the summer we've had. We've come pretty far, and what we've seen is a real whipsaw in terms of interest rate expectations that have fueled this rotation. Whether it can continue remains to be seen. It is summer, it is quiet, which makes tomorrow all the more notable when we get the biggest company in the S&P 500, a $3.1 trillion company, going to be reporting earnings that has driven all of these gains in the indexes so far this year. It does raise a question about how the quietness of this trading activity really does influence the potential magnitude of the move on the heels of those results.
The week begins on Wednesday with NVIDIA earnings. Ed Ludlow sitting down with Jensen Huang of NVIDIA later on in the evening. Do not miss that conversation. And for a lot of you, the big one is Thursday morning, 8:30 Eastern time, jobless claims. Given how the leadership has shifted in this equity market, Lisa, I just wonder, we've gone to small caps, regional banks, moved away from big tech. Does that make this equity market more insulated from a downside surprise on NVIDIA tomorrow afternoon?
We were playing with that idea with Matt Stuckey just there of Northwestern, and he said no, not at all, actually. If you get a downside surprise for NVIDIA, considering how much that's really led all of the gains so far this year in the S&P 500, that'll be a risk-off move, period, full stop. And so that really is the question that I have. How vulnerable is this whole healthy rotation, this whole kind of soft landing nirvana that we've been experiencing? How vulnerable is that to NVIDIA coming out with a negative print? I don't know what the answer is, but it seems like, considering how significant of a weighting it is, it's something that could potentially be a real significant catalyst, especially given the quiescent trading that we see right now.
So from the earnings to the data, this tees up this question. And my answer, I sense from the guests we've had so far that they'd rather take 230 on jobless claims, an inline jobs print on September 6th, and a 25 basis point cut, instead of pronounced weakness in the labour market over the next few weeks and this conversation about maybe going 50. That's my take from what people have said. I'm not saying that's the right call. That seems to be the call of the moment.
Essentially, the Fed is going to cut rates, possibly quite considerably, but the key is whether growth holds up or not, whether maybe the rate cuts that people are pricing in overstate how much of a soft landing we can actually have and how strong the economic data is. People would take an economy that is stronger versus more rate cuts because essentially that's what's going to keep fueling growth. Question is, can the Fed cut nearly as much as people are expecting unless you get that kind of weakness? And frankly, I'm not getting a clear answer on that.
230 is the estimate, in at around 230 on jobless claims for Thursday morning, in line with the previous week as well. Equity futures just a little bit negative here, down 0.1% for the broader market. In the bond market, yields creeping a little bit higher, up by 3 basis points, 384.82. The FX market, a snooze, just like stocks. Euro dollar 111.61. Coming up this hour, we'll catch up with Phil Camporelli of JP Morgan as investors await NVIDIA earnings. Bert Subin of Stifel as Boeing deals with yet another blunder, and Seth Carpenter of Morgan Stanley on the possibility of a dovish September surprise from the Federal Reserve. We begin with the big issue. Markets on hold ahead of NVIDIA. The Nasdaq 100 under pressure as traders await tomorrow's results from the AI giant that's become a critical market driver. Phil Camporelli of JP Morgan staying bullish with this to say. The concentration of stocks driving the market higher makes sense to us given the ability for those companies to manage the current levels of rates as well as the earnings supporting valuations. We believe the momentum in equities can continue. Phil joins us for more. Phil, good morning to you.
Good morning.
Let's get to some of your calls. Overweight US stocks, EM, Japan, high yield credit. What aren't you overweight right now in this market?
Yeah, so we're not overweight cash, and I love your quote that I saw on one of the monitors that said T-bill and chill. That's like nails on a chalk. I'm probably dating myself with this reference, but that's like nails on a chalkboard for me, John. I'll tell you, we still run into that problem, and I'm not talking about should you be in equities or should you be in cash. Okay, I'm a multi-asset portfolio manager. I believe in diversification, and a diversified portfolio last year, when the Fed wasn't cutting rates, was up 16, cash was up 5 on the year. This year, this diversified portfolio is 60-40, is up about 11, and cash is up about 3.5. So we're tripling the return on cash for folks that should probably be in diversified portfolios. And I loved last Friday morning at 10 a.m. The time has come for policy to adjust. I mean, that's like music to the ears of investors after 2 very long years. 2022 was the economy's going to have to go through some pain in order for us to achieve our dual mandate. I still remember pain. And then last year it was basically the message was we're either going to be high for longer or even higher for longer. So I think what we're looking at when we believe the momentum in equities can continue is that these cuts, I think, are going to grease the wheels for the soft landing. And, you know, the Fed cutting without a recession and what we believe between 4 and 5% nominal GDP growth, every investor should be raising their hand for that.
For a while, the sales team, I imagine at JP Morgan, were calling clients and saying, you really should get out of cash. We've got this bond fund. Allocate some long-dated debt. Go into credit. All sorts of things with Bob Michael and co. Have some fun. Are they calling you now, after Friday, to make that move? How resistant have they been?
Yeah, the credit story is still loud and clear. Because the credit story for us is we'd rather play offense in fixed income than defense. So the high yield story, while spreads aren't super wide and we're not going to get this crazy total return, we'll get the total return in equity, John. But we're going to out yield what we believe treasuries and just the core bond funds can do over time, which is a form of alpha, less glamorous than NVIDIA, but it is a form of alpha. But importantly, like this diversification story, what we've seen is that as soon as inflation hits 3 or below, and we're at 2.9 on CPI, you get the right way correlation back with bonds. So you can get a day like August 5th, the highest intraday volatility in the history of the equity market, my first day of vacation, thank you very much, and we can hold on to our overweight to stocks and credit in that environment because we believe that finally bonds are going to be the diversifier that we expect them to be.
If that's the case, why underweight U.S. government bonds?
Because recession is not the base case. We're neutral to our benchmark, okay, in terms of duration, but we'd much rather play the high yield story. So spending the cash in high yield versus the ag. But we don't want to be underweight. We don't want to be underweight in an environment where bonds can protect us.
We were talking to Sebastian Page of T. Rowe Price earlier, and he was talking about how it's important to sort of hedge against a multitude of risks, including owning government bonds in case there is a bigger downturn and holding hard assets in case the inflation picks up more considerably. Why, in your asset allocation, are you overweighting so significantly the idea of a soft landing and a positive economic backdrop?
So it still goes back to us, Lisa, that this is an economy that is interest rate insensitive. So you have a effective mortgage rate in the U.S. right now at 3.9. The average effective mortgage rate when we had a zero interest rate policy from 08 to 15 was 4.3. So in effect, U.S. homeowner with their biggest expense is paying less in their mortgage than they were in a zero interest rate policy, Lisa. So I think there's still interest rate insensitivity. And this, we think, is a cycle that has been trademarked by good behavior from not just the consumer who went out and refied in 2020, 21, and early 22, but also the corporate balance sheet looks pretty good going forward. So again, I don't want to give you the impression that it's rah-rah above trend growth. A necessary consequence of a soft landing is a landing, right? So you have to slow down some, and then that allows the Fed to bring the easing cycle into focus. 100 basis points by the end of the year, Lisa, I agree with you in your last statement. That's a little bit too much. I mean, we were, when people were coming into this year and we had 150 priced in for the full year, people thought that was crazy. Now we have 100 priced into 3 meetings. I think that gets back to something that looks like 1 or 2 25 basis point cuts. But
You're comfortable we can take some of that back and this market will hold up. What would that mean for leadership?
Yeah, I think we saw a snapshot of that in the April trade when you saw the repricing of the federal funds futures market, John. I think that goes back to mega cap tech, right? So you have this small cap rally, the mid cap rally, all this rotation trade. I think that gives it up a little bit. And our highest conviction view is still cap weighted S&P, although our last trade was an equal weighted S&P just because inflation is now at 2.9%, and that should expand some breadth.
I just want to finish up with that last point, this idea of how leveraged this market is to big tech, and we do get NVIDIA earnings tomorrow. How concerned are you that any kind of miss or not a significant enough beat could actually cause a bigger risk-off moment for the market?
Yeah, I think that would be somewhat short-dated, Lisa. Getting back to the point that this market is driven by fundamentals, and it's not a gimmicky rally. Like if you look at the returns of these companies, about half of the return has come from earnings and about half from multiples. If it was all multiples, I'd be right with you, right? But it's not that. But we do believe that they do have to continue to put up the earnings to support the multiples.
What do you think of the move of regional banks? Just to sort of touch on that, what's happening with the financials?
Yeah, a lifeline has now been given.
You don't think it's a gimmicky rally?
I don't think it's gimmicky rally because I don't think it's a gimmicky easing cycle. I think we're actually going to be in the beginning innings of an easing cycle, just not 100 basis points by the end of the year. If that's the case, we have the wrong view on equities.
Got it. Phil, thank you.
Basically, he's saying they're not trash.
They're not trash. I got that.
Yeah, it basically stopped saying that. That was what he was saying.
Is that what Phil's telling me?
Phil was just
it's a
telling you
message
to
to
stop.
me.
Yeah, stop calling.
Trying to start fights around the table or something. What's wrong with you?
Oasis got back together.
I saw that. Would you buy tickets?
Yes, I would, but you would beat me to it.
Okay. Would you like to go together? We can do that next summer. We'll make that happen, Phil. All right. Team outing. Phil Camporelli at JP Morgan. Phil, thank you, sir. Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's your Hara Heckes.
Hi, John. Eli Lilly is now selling vials of its blockbuster weight loss drug Zepbound to patients at about half of the cost of its widely popular shots. Patients with a prescription for Zepbound can purchase a month's supply of single-use vials through Lilly's direct-to-consumer site starting Tuesday for as little as $399 a month. A higher dose is going for $549 a month. The move is part of Lilly's all-hands-on-deck effort to ramp up supply of Zepbound and a similar drug for diabetes called Mounjaro amid widespread shortages. Meanwhile, Disney is still in contract renewal talks with DirecTV. The satellite TV provider is looking to no longer charge customers for channels like ESPN if the customer would like to opt out. This is a major change from the previous negotiations where channels were bundled together. According to reports, Disney is open to the idea of offering some sports-specific packages to distributors. It's also willing to offer other types of smaller packages and negotiate some lower minimum subscriber guarantees. And history has been made in Major League Baseball with one player appearing for both teams in the same game. Danny Jansen was catching for the Toronto Blue Jays when their June 26th match against the Boston Red Sox was suspended due to rain. Jansen was then traded to the Red Sox in July, and when the teams resumed the match yesterday, Jansen was playing for the Red Sox. It's the first time ever a player has appeared for both teams in a single game. That's your Bloomberg Brief. John?
Yeah, Hara, thank you. Pause. I've lived here a long time, and I've taken a lot of abuse about my first love, my second love, football.
I saved.
That was close.
Yeah.
Baseball. What on earth is that? How do you play for two teams at the same time?
I thought it was very clear. It was just explained that the game was postponed to a different day, and he was traded. Between the 2 days.
Shots fired.
Yeah.
Bizarre.
Yahira did a great job with that.
I get it. All right.
Go, Yahira.
The Yankees getting it done.
Yes, first place.
I've just
Tell my friend Tom, please.
Above Baltimore. I'm next on the program. The morning calls. Plus, Bert Subin of Stiefel as Boeing grapples with the future of its space program. That's just around the corner from New York. This is Bloomberg.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The opening bell, 1 hour and 15 minutes away. Equity futures slightly softer, negative on the S&P 500, down 0.1%. Bond yields higher by 3 basis points on the US 10-year, 3.84.82. In foreign exchange, the euro not doing much, 111.59, and crude pulling back by 0.6% after a recent rally. We're down to about 76.95 on WTI. That's some of the cross-asset price action for you. Let's take the opportunity to get you some morning calls. First up, Citi downgrading Hershey to sell with a price target of 182. The analyst seeing a challenging year for the chocolate giant thanks to volume weakness and cocoa inflation. That stock is down by 1.8% in early trading. Your second call from Morgan Stanley, raising its price target on Coca-Cola to a street high 78 with an overweight rating. The analyst naming Coke his top beverage pick, replacing rival Pepsi. That stock is up by 0.5%. And finally, your third and final call from Truist, raising its price target on Nvidia to 145 and keeping a buy rating ahead of tomorrow's earnings. The firm saying that discussions with component buyers and sellers point to improving business trends for the chip maker. We're down by about 0.5%. Given those channel checks, so to speak, a lot of people are seeing the same numbers, hearing from the same customers. It'd be a big surprise if this number was weak, based on what we already know over this earnings season so far.
There have been 7 straight quarters of beats, and not just beats, but these beats are not just your average ones. They are astronomical, as well as upgrades to potential earnings forecasts for NVIDIA. How big of even an in-line would this have to be something that would be very negative for a stock that otherwise is very much front and center, and people are just seeing every opportunity for them to continue minting money?
Stock just a little bit softer in the pre-market. The big number coming tomorrow afternoon. Said this a few times, but don't miss that conversation with the CEO, Jensen Huang, sitting down with Bloomberg's Ed Ludlow on the West Coast tomorrow evening. Must-watch TV. Let's turn to the aerospace industry as Boeing faces another reckoning, this time over its space program. Bert Subin of Stifel is looking ahead to 2025 delivery expectations as the company builds up inventory. Bert joins us now for more. Bert, I think we need to take a giant step back and talk about this overall company, the challenges for the incoming CEO. We've got commercial planes, Boeing Defense, and then we've got the venture into space. And that's where the difficulty is right now. Given the to-do list, how long is that to-do list for that new CEO?
Yeah, well, thanks for having me on the program. It's certainly a long to-do list. What we've been looking for over the last few months was first, to get a successor CEO in the door and to sort of check mark on that. And from here, Mr. Ortberg just started 3 weeks ago. And so he's in the process of, meeting with customers, trying to understand the problems and sort of put forth a solution. And so, unfortunately, you've seen a couple of, negative headlines over the last 2 weeks between the 777X having a setback and then Starliner, obviously, over the weekend, announcing that SpaceX is going to bring back the 2 astronauts up there. But, maybe just to contextualize things, because I think it's important as you think about the Boeing story, the BDS business, which houses the space business, makes up about 25% of the normalized business, call it a 33% of the business today. And within that business, 15% of it is the fixed price development programs, of which Starliner is one of them. So this program itself is relatively small, which is why you tend to see a lot more focus on the BCA side, the airplane side, and within that, a lot of focus on the 737 program.
There's also a lot of questions around why Boeing should keep their space program, considering how many losses they've posted for this. If Boeing were to announce that it was jettisoning its fleet and its sort of relationship with NASA, how much could this share price rally?
Yeah, I'm not, it's an interesting question. I mean, the space program itself, I think we think of it as the United Launch Alliance, which is a joint venture between them and Lockheed, which is already been rumored to be potentially sold. I think the number out there is $3 billion, so they could be monetizing part of that. There's the Space Launch System, which is the SLS program. That's what's called a cost plus program. And so the risk there is much lower. The NASA takes the risk. And then you have the Starliner program, and obviously engineering and other things that go into NASA. Boeing's been working with NASA for decades. So I guess the question would be, what do they see from the space business longer term? Is this an area where they want to be exposed down the road, or do they want to sort of tighten their focus on the commercial airplane business? I compare it to Lockheed. They used to compete in commercial airplanes. They decided they were much better in fighters and satellites and weapons, and they went down that path, and that was very successful for them. So, I think if they got out of this business, investors would look at it as, potentially reducing a future cash drag, but perhaps at the expense of sort of reducing an opportunity in space down the road. So, it'd be an interesting decision, just interesting sort of thought process on how Mr. Roper goes through this as he thinks about, the future of Boeing.
Bert, taking a step back, there's been this question of whether Airbus would be able to capitalize on some of the problems that we've seen on Boeing and whether they could really take the lead in a more meaningful way. I have been surprised that they have not. And one of the reasons why is because they are facing off with the same kind of supply chain issues that Boeing is, maybe a little bit less publicized. But I'm just wondering whether we have fully emerged from the sort of post-pandemic induced supply chain disruptions that's continued to plague the aerospace industry.
Yeah, it's a great point. Look, Airbus, I think everybody thought after January, Airbus was going to be in this position to take all this market share, and there's certainly been limits to what they've been able to do. But for Airbus is, a positive for Airbus that people I think overlook is, they have really high targets. So they're talking about getting to 75 on the A320 per month. Boeing is talking about getting to 50 on the 737. So, Airbus is already close to 50 on their program, maybe even certain months above that number. So they're progressing pretty well, but they've seen limits on their ability to get to their targets, and they keep extending that. And part of that has been supply chain driven. There are many tiers of the supply chain. There has to be an orchestration on how they work together. There's been raw material shortages. There's been geopolitical issues. There's been labor issues. And so these things have compounded. And surprisingly, here we are, 4 years past the start of the pandemic, more than that now, and we're still talking about supply chain. But, as we go into 25, I think there's reason to be optimistic about where the supply chain's heading. And that's part of why we think, Boeing starts to look better. Where expectations are today is a lot lower where they were a year ago. And as the supply chain catches up, as Boeing stabilizes production, they get back into a position where they can sort of, stem some of the market share losses they've seen to date, and then ideally start building more orders and sort of take away that potential advantage Airbus would have had.
This is a tough question, and I don't know if we can actually get a real answer, but how much is Boeing in a better or worse position because it is the American darling, because it is a U.S. company at a time of increasing fissures, especially as the likes of Boeing really has a huge presence in defense spending globally? How much is this really turning into sort of the fiefdoms of who your allies are in terms of who decides to do business with, say, Boeing versus Airbus?
Yeah, you're right. That is a tough question. Look, I think right now there's a third player that's emerging, very early days, but it's called Comac. It's the Chinese backed aircraft producer, and they have a program called the C919, which is going to compete with the 737 and the A320. And still, like I said, very early days, using a lot of the same parts that would go into a Boeing and Airbus aircraft, but obviously early on that journey. So, the question is, Boeing put out some sort of refreshed numbers on what they think the China setup will look like longer term, and that is rising. And so the question will be, does China opt to purchase more Airbus aircraft, and do they purchase more Comac aircraft as you go down the road? And that limits an opportunity for Boeing. Outside of that, I don't think there's this major issue between which countries choose to do business with Airbus or Boeing. Airbus has certainly been the preferred partner of late, but the reality is if you want a new A320 aircraft, the waiting list is now 2031 to 2032. And so that is not an aircraft you're ordering today to get in 27 or 28. With Boeing, you could be getting that aircraft 3 to 4 years earlier, and so that's an advantage. And so I think airlines continue to look at, what aircraft do we need for our mission? When can we get those aircraft? What's the price of the aircraft, and what's our confidence in the company? Probably more so than that. But then there's the China question, and so that may be a benefit as we think about Airbus versus Boeing.
But how difficult is it for airlines to make capacity decisions when they don't know when they can get planes? And if they do want new planes, they've got to wait. that long for them. And they've got no idea where the economy or the market will be once they arrive.
Yeah, it's very difficult. And what we've seen, what typically happens is there's, call it 2 to 3% of your aircraft globally get retired every year. And so that number's been quite low. And what we've seen is the average age of the global fleet has been about 20% higher than it was in 2018. And what that's meant is there's this whole industry called the aftermarket, which has benefited from selling parts and services because older aircraft need more parts and services. And so what airlines have had to do is take up their OpEx because they've had to use older aircraft. And they've also been limited in how much they can grow because they've been unable to get their new aircraft. I mean, just for example, Southwest was supposed to get something like 79 aircraft this year, and they're going to get closer to 20. And so that obviously has a huge change on what you're expecting to grow versus what you can actually grow. But it's actually probably been a good thing for the airline industry because it's sort of mandated more capacity to stay in check. Imagine had we not been in that position and airlines been buying more aircraft, what we're seeing from a yield perspective would be certainly a lot worse today if they were growing faster. So it's been a positive from that perspective.
Bert, this was awesome. Just the clinic. Appreciate it, sir. Thank you. Bert Subin there of Stifel. You know when you get on the plane and you see the sign, the no smoking sign, and you're like, this thing is old. Really, really
feel
old.
it. I mean, that's the consequence.
My goodness. That's like the sign. I'm like looking around. Don't want to be on this plane.
Holding the doors up.
No smoking signs on the plane. Not good. With ashtrays.
Yeah.
Yeah.
I haven't been in one of those. Come on.
Yeah. No, that's what I mean. Like they've got the ashtrays and the no smoking sign.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
Ashtray indicator, real thing. Real thing. And now lots of people are sending me their thing. Simple rule, plane younger than me, pilot older than me. The latter's become much tougher, according to this gentleman on the Bloomberg terminal.
I really would like to see. Please write in if you've actually been in a plane with an ashtray recently. I don't believe you. Come on. Like, yes, the no smoking signs, yes. But the ashtrays? Oh, wait, hold on a second.
Yes, okay, you go on. Share it.
Oh, I didn't even realize that was an ashtray. Never mind.
What are you looking at?
A picture of what they look like. You mean in the lavatory?
So now you've seen, are you telling me you've found pictures of planes and didn't realize what an ashtray looked like? Is that what you're saying?
No, I'm not.
You know we're live right now. Not the commercial break anymore.
Let's move on. All right.
60 minutes away from the open and bound. Markets. Equity futures on the S&P 500. Negative by 1/10%. On the NASDAQ, down 1/10. On the Russell, outperformance yesterday and through much of last week, particularly the back end of last week. Underperformance this morning. We're down 0.4% on the small caps. I want to turn to the bond market, spend a little bit of time on treasuries, and then we'll get over to the gilt market as well. The 2-year, we'll get some supply a little bit later on. We will get $28 billion worth. Tomorrow, fives, $70 billion worth. Day after, $44 billion of 7-year notes. Yields into that, up 3 or 4 basis points on a 10-year, 385 at the front end of the curve. Still in and around 4%. We're kind of sort of glued to that.
Yeah.
Gravity, 394.78.
It's hard to see what's really going to move things significantly without some economic data. You do wonder how coiled this market is heading into the jobless claims that we get on Thursday. But otherwise, I mean, the 2-year auction that we get later today at 1 p.m., unclear exactly how much that's going to move the needle, considering that there's plenty of demand. The 7-year auction, I think, gets more interesting on Thursday, and that's what I'm going to be watching.
Gilts are going to get interesting. So let's switch on the board and get to the UK government bond market. Selling off as well, just a little bit. Yields are up across the board. From the 2-year out to the 30-year. We're up about 4 basis points across the curve, up a little bit more on a 10-year maturity. The words of Sir Keir Starmer, the British Prime Minister, that the autumn budget will be painful. Short-term pain for long-term good. Things are worse than we ever imagined, which I have some difficulties understanding because the finances of any government are pretty transparent, so they should have had a decent read on the finances before they went into government. So I'd like some more detail there. What didn't they know that they know now? And then I would be asking, well, shouldn't you know what you know now? And why is this going to be so painful come October?
Yeah, calling it 14 years of rot under the prior Conservative rule and talking about painful choices. It's going to be painful. We have no other choice given the situation we're in. Question, is this basically setting up for tax hikes, essentially saying we need to raise more money, it's going to be painful? Is this saying we're not going to be able to provide certain social services? Or is this going to be neither, and it's just going to be a period of atrophying growth at the expense of the reputation of the country? I don't know the answer. I do think that the response in markets is interesting. And you raised this point, and I've been trying to find an answer, and I can't.
Sure.
Why are yields higher? If you think that they're going to be increasing taxes and they're going to be potentially paying down some of the debt, wouldn't that mean that yields would be lower, especially if it does come with anemic growth?
Just to follow the political instincts, and we'll start with the policies first. This is the Labour Party. They would say they're somewhat centre-left. You can decide where they would sit on the spectrum of politics. That's where they'd put themselves. Their instinct is to have a big role, that the state should be bigger. And my view would be that given they think that we've had 14 years of rot, they believe there's enough money, there's enough things to spend money on. If you want to throw money at a lot of these things, you need to raise it. So you're going to see both, Lisa. You're going to see big spending programs because we need to spend X on this, and then big revenue raises. Taxes are going to have to go up.
Yeah, taxes in particular on people who have property in the UK but don't live there. And that's actually something that came up in this, some of those types of policies.
This is why specific policies matter, you know, like really, really matter. You can get away in an election just saying, you know, you're not the other person and win and find yourself up in power. And then you can be on the receiving end of some of these policies in the country and think, oh, I didn't vote for this, right? This, I think, is applicable to what's happening here in the United States of America. We've got 2 months now. to find out what the Harris campaign actually stands for and what the policies are and will be if they get into power, so that you're not surprised further down the line.
Yeah, in fairness, to find out what the policies are on both sides. We have no idea what Donald Trump 2.0, and we don't have an idea of what Kamala Harris will be, whether she'll be a continuation of President Biden or not. Bottom line is, I don't think it's likely that we're going to get any real policy prescription in detail before the election, but I think it's very sweet to hope that we do.
Which kind of like hope casting, some of this, sort of hoping for it. All right. Under surveillance this morning, President Biden's top security aide, Jake Sullivan, meeting with his Chinese counterpart as both countries look to keep the dialogue open. Sullivan is the first U.S. national security advisor to visit China since 2016, and Lisa's got questions. Why is he there?
Why now, I think, is the bigger question, is simply because we're not very far out to when Joe Biden no longer is president, so it's unclear how much leverage there actually is or whether they're actually talking about policy. I think that what was really notable to me, and Mike Shepard of Bloomberg pointed this out earlier, this is a do no harm type of visit. Please don't surprise us with anything ahead of the election. Please try to get on board with us. Maybe even, can you work with us a little bit to try to create some peace between Russia and Ukraine? More than, say, the tit for tat that we had been hearing with, say, some of the visits that we saw with Janet Yellen.
They haven't been able to influence them on foreign policy at all, at least not publicly, not that we've seen. We've seen no public policy shift out of China off the back of these visits at all, bottom line.
Honestly, I just don't have a clear sense of what actually is discussed, whether they have leverage, who they're talking with, whether anyone in China has leverage other than Xi Jinping. I mean, there are a lot of questions about some of these negotiations. I'm just curious about the timing at this point, given the fact that to any extent that they didn't have leverage before, they probably have even less now.
Yeah, that's the latest on that front. I want to turn to Apple. We promised you an update on this story a little bit earlier. The longtime Apple CFO, Luca Maestri, will step down at the end of the year after more than a decade in his position. Apple's saying he's set to take on a smaller role at the company, continue to oversee IT and real estate functions. So he's hanging around, but he's had quite a run. 10 years. And if you go back to 2014, I think he took over from, was it Peter Oppenheimer? Back in 2014, I think it was. And Oppenheimer was really responsible for that big change in the balance sheet at Apple, how to use the cash. And I always think of Apple as going from, say, the Steve Jobs years of product innovation to the Tim Cook years of just sort of like financial innovation, the financial engineering of the balance sheet, huge monster capital return programs, and Luca Maestri very much at the epicenter of a lot of that.
And the transition to a services company, not just a products company, but also very much a services company. All I can say is congratulations to Luca Maestri. I don't know if he's going to actually be spending a lot less time there in his reduced role, but he's 60 years old, has a pile of cash, and he could probably go spend it. So I assume he is going to have more time to do so.
He's got one eye on a villa in Como and a nice Aqua Riva to go along with it.
Stop projecting.
You know, these are my wants, I know.
Evidently.
All right. Well, most investors await Nvidia earnings. There are two more data points this week that could factor into the Fed's next move. Thursday, jobless claims, and Friday, core PCE. Seth Carpenter at Morgan Stanley weighing in on the importance of jobs data for the Fed, writing this. The labor market is now more of a concern than before, and Powell wants no further softening. We maintain our view that the cutting cycle will start and continue with 25 basis point cuts, but a substantially weaker job market would mean bigger or more cuts. Seth joins us for more. Seth, good morning. It's good to see you.
Great to see you, Jonathan.
You teed it up. What's the difference between 25 and 50? What does that number look like?
You know, I think coming into the labor market report is going to be the big one a week from Friday. Probably something in the 100,000 range, especially when you consider that the last report that everyone freaked out about initially was suppressed by some of the hurricane effects. If you factor in some sort of bounce back and you get a labor market report that's in the 100,000 range, that's going to sort of say, I think pretty clearly, a bit more of a slowdown than we wanted. And now you've had this chorus from the FOMC coming out saying, it's time to start cutting rates. We want to try to prolong the expansion. We want to try to, you know, keep employment going.
How much faith do you have in their ability to extend the cycle?
It's a hard thing to quantify. I mean, I think one of the most critical parts of this whole cycle, and one of the reasons why we, going back 2.5 years, have been calling for a soft landing, one of the most critical factors is a desire and a willingness to do it. Doesn't mean that they're going to achieve it, but the fact that that's actually what they're trying to achieve, I think, is critical. And so if we do see signs that things are slowing down too much, slowing down to the point where we might have a slump, I think they are going to be ready to take action.
Well, I think that the other side of that question, just to build on it, is the theme of this Jackson Hole meeting was assessing monetary policy efficacy and just the transmission efforts. Didn't get a real answer on just how significant their ability to influence the economy is in one way or another. But to the extent that people say that this economy was interest rate insensitive, how much will it be on the way down? In other words, how much are we already seeing the boosts from some of these easing monetary conditions because they're being baked into the market already?
No, I think that is one of the key questions for this cycle is how sensitive or not has the economy been to interest rate changes. But as you know, the markets are forward-looking. The market has already rallied a lot in terms of interest rates coming down a lot over the past few months. We've seen credit spreads, despite the turmoil after the last jobs report, they're still pretty tight by historical standards. And then I think once the policy rate actually starts moving down and any debt that's directly indexed to the floating rate, that'll start to come down, I think we will start to see some relief. That's, for us, a key part of why we think the Fed is going to achieve a soft landing. But it's going to take a while. If you look at the housing market, usually one of the key components of any monetary policy cycle, even with the fall that we've seen so far in mortgage rates, people made a lot about the surge in mortgage applications. Quantitatively, it just wasn't that big a deal. So in that regard, the housing market, most mortgages are pretty far out of the money.
Let's go there to the housing market, because that's been the anomaly in this whole cycle. It's been the market that's been torpedoed, and yet prices have remained elevated because of all of those people who are staying in their homes because they got mortgages at really good rates. So why should they move? But there is this issue going forward about whether lower rates are going to cause prices to keep going up even further, whether this will actually cause markets to be more affordable or just simply become more so.
I think it's real tricky, and the affordability measure, I think, that you're getting at is a really complicated one, because usually, and a big shout out to my colleague Jim Egan, who does all of our housing forecasting at Morgan Stanley, thinking about affordability, it's the combination of the price and then the mortgage rate. Put those two together and think about what the monthly payment is relative to income. We're actually at a place where affordability is about as bad as we've seen if you can consistently collect those data. Lower mortgage rates will unquestionably help a bit in the short run, but I do think you're hitting on a real question. And moreover, there is, at sort of a generational kind of frequency, a shortage of housing. There are a lot of 25 to 35-year-olds that don't own homes that would normally be primed to start buying homes. And so we don't look for a material weakening in home prices at all. And I think your question, could home prices go up further with rate cuts? I think that should be on the table.
Shelter prices, can we sit on this a little bit longer? What about the cost of renting? What's going to happen more broadly to the cost of shelter when rates come down?
So we think, so that's tricky. So the BLS data are very backward-looking.
Super hard. I know.
BLS data are super backward-looking. If we look at what's going on right now in markets for new rents, it does seem like things have stabilized, and so we expect rent inflation, as measured in the components in the CPI, to keep coming down for the rest of this year and into the beginning of next year. Normally what happens when you get a big increase in rent inflation, it's coming from lots of job creation, lots of extra demand for housing. So we're not expecting a big takeoff at any point over the next year or so, but it's not going to keep coming down the way it has been for the past year.
Seth, this was great. It's good to see you.
Thanks,
Thank you, sir. Seth Carpenter there of Morgan Stanley. The latest on the economy and the Federal Reserve. Joining us now is Eric Nelson of Wells Fargo. Eric, just to follow on from that conversation, the kind of number that you'd expect to see that would change this conversation of the Federal Reserve from 25 to 50 for September 18th. What do those numbers look like between now and then?
Well, John, I think it's probably the unemployment rate, right? If you stick at 4.2 or go up to 4.3, and you probably see a non-farm payrolls number below 100K, certainly well below 100K, that could probably get the Fed to go 50. I think what people are sort of missing here, too, is the discussion around the front meeting, i.e. the September meeting, versus the terminal rate, right? Because, yes, markets are geared up for a 50 basis point rate cut, and if you get a strong number, you could see a bit of a whipsawing in rates, but you know, markets are not even close to pricing in a hard landing here. And if you get a really bad number, it's not just that first meeting or two that's going to reprice. It's the terminal rate, and it's going to reprice a lot lower.
So, Eric, with that in mind, what would that mean for foreign exchange? How would you push that through the FX market? And do you have a favored currency pair to play that with?
Yeah, this is very much a classic question here of walking this soft landing tightrope with the dollar, right? And you look at the dollar Canada exchange rate, U.S. dollar versus the Canadian dollar, that has moved sharply lower in the span of just a couple weeks. And this is the ultimate soft landing trade, right? It's lower U.S. rates versus Canadian rates, and not too much concern around U.S. growth slowdown. to me, it's very difficult to see U.S. dollar CAD exchange rate go much lower here. I think if you get a very weak number, suddenly those growth concerns come into play. Obviously, Canada very exposed to U.S., and you see dollar CAD move back higher. Or if you get a stronger number, it's simply a U.S. rates play, and we see dollar strength.
So just you're making a pretty big call here, Eric. Let's just put a bow on this. The idea that you think that the dollar weakness is overblown and that you actually think that you're going to see more dollar strength going forward. How much confidence do you have in that type of trade at a time where we're talking about a potential tsunami of selling coming from Asia as the Federal Reserve cuts rates?
Well, Lisa, I think it's important to keep in mind here that political concerns are very much a big piece of this dollar puzzle, right? Who's in the White House in 2 or 3 months' time or so, or rather, who's elected to be the next president of the United States is a huge factor here, right? If you do see Trump come back into play, suddenly the trade concerns, the tariff concerns come right back into the fore, and we start to worry about dollar strength again. I'm not too worried about the noise around dollar devaluation. To me, the trade sort of measures are the signal. If we don't see that, if Harris is victorious, then I do think some of that risk premium continues to come out, at least as it regards FX. But all that said, growth is growth, and who wins the White House in November is probably not going to have that much near-term impact on growth. So either way, I think it's difficult to see a lot of near-term dollar weakness.
So hold on a second, Eric. Are you basically saying the Trump trade is more dollar strength and that the Harris trade is potentially dollar neutral or dollar weak?
Yes, and certainly it depends on which currency pair we're talking about, right? I mean, if you do see Trump come back into the picture, naturally, China will be a concern, Mexico to some extent as well. But I think broad risk-sensitive emerging market currencies, trade-sensitive currencies, all likely to be on the weak side. Again, with Harris, you do still have this growth sort of slowdown to worry about here. A real hard landing is not even close to being priced in our view, and that's an upside risk for the dollar. But I think that trade sort of factor of being a dollar positive, without Trump in the White House, that to me is a key dollar positive sort of catalyst removed.
You brought up EM. You're sitting in London. Let's talk about sterling. Out of the three of us, only I can say that. Let's talk about the pound and what's happening. I want to go to the words of Sir Keir Starmer that Lisa's picked up on this morning. Things are worse than we ever imagined. It's going to be painful. We have no other choice given the situation we're in. The October budget statement will be painful. Eric, in DM world, when the leader of that country says something like that, I think austerity, I think a central bank that's going to have to lower rates, I think of a big rally in the bond market. Eric, what does that mean to you, and what does it mean for this currency?
Yeah, certainly pessimism is not in short supply these days around these parts. I think what's really key to me here is, you listen to Starmer, and there's a lot of talk around, it's an absolute disaster, but they've already struck a deal with some of the public sector unions, right? They're already starting to sort of move toward making strides in opening up some budget space with regards to reclassifying how the Bank of England thinks about QE and QT losses. Right, so there's room here for the UK government to actually sort of take some steps toward providing more investment spending. They want to lean on the private sector. To me, this is not the 2010s all over again. But obviously, I think, and you were talking about this earlier, it's hard not to see some degree of tax increase, whether it's on capital gains or what have you, to sort of offset some of those spending increases that they want to affect.
But can you just sort of build this out a little bit? Because we were struggling to understand, if you're raising taxes to pay for some of this, shouldn't that be positive for the overall budget? Why should you see some sort of sell-off in a bond market at a time where you're going to see slow growth and potentially some sort of retrenchment in terms of budgetary constraints?
Well, I think what's key here, Lisa, is the fiscal picture is really just one piece of the puzzle, right? I mean, you look at UK wage growth versus any other country in the G7. It's still running 5-6%, a full 2-3 percentage points ahead of anywhere else. Services inflation, similar kind of picture, 5-5.5%. Yes, the fiscal situation is still concerning here, but nominal growth in the UK is still pretty strong, right? And that's really what's keeping, I think, that Bank of England pricing a little bit stickier, not seeing as many cuts priced, and frankly, that is preventing, this huge rally in gilts, even though we are talking about a bit more of a, maybe not austerity per se, but at least a more orthodox budget policy out of this new government.
Eric, an old friend of mine once said to me, you never want someone else's problems. And I think the same applies to countries as well, and economies. Everyone's got their own problems right now. The UK, Europe, within Europe, Germany, China, in the United States as well. Eric, when we start to hear things in the FX market about money coming out of the United States and going elsewhere, I've been asking the question, Lisa's asked it too, going where? Stephen Jen said this, Chinese companies may be enticed to sell a $1 trillion pile of dollar-denominated assets as the US cuts interest rates. He went on to say that that move could generate a move in the Chinese yuan by up to 10%. Stephen Jen is a legend of the FX market. I am nobody to argue with him. I want your perspective. Eric, where do you think that money's going to go if it comes out of the United States? Do you think it will leave the US off the back of those rate cuts?
Yeah, John, I'm not fully convinced on this argument. I think part of the issue is if you look at a fuller capital flow picture, say look at the FX settlement data, Chinese banks on behalf of residents, those are still pointing to outflows out of China, right? And we're not quite on the scale we saw in 2015-16. But it's pretty clear to me that, away from the export picture, people are still trying to get money out of China. It's a natural offset to the relatively wide manufacturing surplus we're seeing on the current account side. But it doesn't seem to me that there's this wave of money waiting to come back into China and out of dollars. And look, you go back to 2002, 2001, right? Very popular, massive inflows into U.S. tech in the late 90s. You saw money flow out of U.S. tech in 2000, 2001. Guess what? The dollar went up. It was global economic weakness. Even as the Fed was cutting rates, the dollar was pretty resilient. So there's a lot more to this picture here than just, who's buying what assets, in any sort of window of time.
Got it. Eric, thank you, sir. Appreciate it. Eric Nelson of Wells Fargo out of London. Equity futures just rolling over, down about 1/3 of 1% on the S&P. With some news elsewhere with your Bloomberg brief, here's Yahara Hackers.
Hi, John. Shares of Paramount are trading lower in the pre-market, down 4.7% after Edgar Bronfman Jr. announced he was dropping out of the bidding war for the company. Bronfman submitted a $6 billion proposal for the entertainment firm last week, challenging an earlier offer from Skydance Media. Sources say Skydance accused Paramount of breaching the terms of their merger agreement by continuing to engage with another suitor. Meanwhile, Donald Trump is already thinking about who he'd put in his cabinet if elected to his second term in the White House. Trump saying he would ask Tesla CEO Elon Musk to serve as a federal cost-cutting consultant, but noting the billionaire might not have time. Trump also said Musk could give some very good ideas on things like AI. Musk endorsed Trump last month and created a super PAC to support his re-election effort. And Coco Gauff comfortably advanced to the second round of the U.S. Open with a straight sets win in the first round. The third-seeded Gauff, who won the U.S. Open last year, shaking off some early rust to advance 6-2, 6-love. But not such good news for fellow American Sloane Stephens, who was knocked out in 3 sets despite winning the opening set 6-love. That's your Bloomberg brief. John?
It was a great game. Yahara, thank you. Up next on the program, we'll set you up the day ahead, the week ahead, just around the corner.
Money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The opening about 36 minutes away. Stocks pulling back by 1/3 of 1%. Just a little bit of weakness building going into the cash open with bond yields a little bit higher. The 10-year continues to cheapen. 385.96. We're up by 4 basis points on a 10-year. Big week ahead. It kicks off tomorrow. Before we get there, at 10 a.m. Eastern Time, we'll get U.S. consumer confidence data Wednesday. That's when the week begins. NVIDIA reporting after the closing bell. Plus, we'll get some Fed speak from Raphael Bostic. Thursday, for the economists and bond traders alike, it's U.S. GDP and another round of jobless claims. And on Friday, we'll get core PCE and UMich consumer sentiment. Lisa, a final word, please.
Just how hinged this market is really to a couple of key data points in an otherwise quiet trading range. I mean, honestly, you could talk about weakness rolling over, but it's very hard to see this as anything more than noise and, say, signal at a time where NVIDIA, which is the biggest company and accounting for something like 5-6% of the overall S&P 500 index, is potentially ready to roil the markets. I just wonder how outsized that move could actually be.
Nice to have some quiet, isn't it? Don't you think?
Yeah.
Just a little summer Tuesday.
You know, the more you say that, the more everyone's throwing things
New
at the
Yorkers
screen.
sort of wish, like, Americans,
Yes.
okay? I love you. This is my home. Thank you for allowing me to make this my home.
But
why do you wish away summer in the middle of August? Why do we do it?
who are you talking to?
We wish away summer, start getting excited about pumpkin.
Okay. Okay. Have you had a pumpkin latte?
No, I don't want one either.
Okay, no,
And then
I know.
The leaves turning brown.
Yes,
But I just,
it's not brown. They turn beautiful colors.
No.
Jade. Have you never gone
I
peeping?
see that and I think winter.
Okay, well,
And I'm thinking
that's-
like 6 months of darkness.
maybe we need to talk about that because you should go and see the leaves changing.
I've
The
done
leaves are
therapy on this,
beautiful.
believe me. Many times.
I can't even.
Many times. Apart from that, I love it.
Yeah, I'm going to
All
get you a pumpkin latte.
I just
for
hold on to
tomorrow.
summer. I love
okay,
it. I
all
love
right,
summer.
Okay, we're going to talk about summer tomorrow.
Yeah.
Okay, all day.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the Quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about. They fail the Quark test. My finance team knows this Quark test. And at Google, I'm working with amazing computer scientists, so they never fail the Quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks continuing to struggle after yesterday's slide. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off this week, and Bloomberg Open Interest starts right now.
Coming up, Wall Street remains on edge. Investors waiting for NVIDIA earnings and further clarity on the AI boom. And a heavy slate of eco data this week, also adding to the wait-and-see mood. Next hour, we're going to get the latest read on consumer confidence. Plus, IPO hopefuls face a tough choice. Take the leap, go public this fall, or wait until next year when risks may subside. We'll discuss that dilemma later this hour. Meanwhile, let's take a look at where markets are trading. About 30 minutes to go until the cash open. You can see not too pretty behind me. Of course, you have the S&P 500 down about 0.3% pre-market. You take a look at the NASDAQ 100 down nearly 1% yesterday, continuing that fall today, down about 0.4%. Meanwhile, a little bit of a sell-off in the bond market, not the haven-seeking bid you might expect to see. 10-year Treasury yields currently up about 4 basis points, Shonali.
It's interesting. It's a reversal from what we've seen the last couple of weeks, but we're also watching some individual stocks, some pre-market movers on our radar. Kava now under pressure after the chain's largest shareholder and a group of investors filed to sell shares. Kava shares down pre-market more than 8%. The stock soared around 25% last week following earnings and bets on interest rate cuts. We're also watching Skydance Media set to become the new owner of Paramount by mid-2025. Edgar Bronfman Jr. has dropped his bid for the media giant. And of course, you now have Paramount Global still down about 4.3% pre-market. Remember, they have scrapped their Go Shop provision at this point. We're also watching Amazon. The company signed a $100 million deal for the Kelsey Brothers podcast. The 3-year deal includes advertising and merchandising, and Amazon down 0.3%. But of course, Katie, we've seen weakness in big tech this week so far overall.
Yeah, that is super interesting just on that podcast news. Similar to what we saw last week, of course, with SiriusXM and Alex Cooper of Call Her Daddy fame. A lot of interest and intrigue in the podcast industry right now. But let's switch gears, get back to markets, because joining us at the desk, I'm thrilled to say we have Rebecca Patterson. She is former chief investment strategist over at Bridgewater Associates, now joining us. And we were chatting a little bit before the show started how we're in this interesting in-between period. We're past Jackson Hole, it's before NVIDIA earnings, and it's before September. Interesting to see markets kind of on a downdraft, even after Jerome Powell basically said last week, I'm going to cut interest rates in September.
Yeah, I mean, I think it makes sense that we're consolidating a little bit and even giving back a tiny bit. Remember, we're in a period right now where the liquidity in the markets is not
robust, let's say, and so it doesn't take a lot of selling to pull things down a bit. But with so much priced in for the Fed now, we have between 1 and 2 25 basis points cuts priced in for September, 100 for the end of this year. And then if we look out to the end of next year, over 225 basis points of cuts priced in. So it makes sense that lower interest rate environment, that's now largely discounted into market valuation. So we need a new catalyst, and that catalyst could come from some of the economic data we get this week and going into September. It could certainly come from earnings tomorrow or in the days ahead. But we're kind of waiting for that now.
Well, just focusing on the Fed, we were discussing a little bit yesterday how it seems like the markets and Fed policymakers are more closely aligned than they have been over the course of the past year or so. When you take a look at the economic data, at signals we could get from Fed speakers, is it maybe a more open door to 50 basis points in September, or maybe more interest rate cuts overall that would finally push us to all-time highs?
I mean, again, a lot is priced in on the interest rate side. So personally, I think the data will matter. The Fed's right. They are data dependent. And so if we got soft jobs numbers, if we got more disinflation coming through, bad consumer confidence, we have numbers coming out later today, that could push the Fed to a 50. Personally, I'm on the fence whether we get 25 or 50 at this next meeting. They're very restrictive now. So just to get closer to neutral on interest rates, they could decide to do it a little faster and get to 50. But at the same time, they're watching, how much is the consumer slowing? How much is the labor market slowing? What kind of financial conditions easing is passing through? And so I think they're going to want to pace it sort of carefully till they see how this is feeding through. And that's going to take a few months. So I guess I'd be leaning more towards 25 and a measured pace while they're watching the data and how it's feeding through.
Because it's been such a big topic of discussion this year and a big element of uncertainty, let's talk about the consumer scenario plan a little bit, because we had that consumer sentiment data, like you said, at the top of the hour. We have University of Michigan data at the end of the week. We have a ton of retail earnings. Even if you get 25 or 50 basis points worth of rate cuts, how much does that improve the consumer story given the lags that there are after you see those cuts?
I think this is such an important thing, not just for the Fed, but for all of us who are watching the markets and investing in markets, because as people priced in an easier Fed, they've also been pricing in a greater chance of a soft landing. And we've seen that reflected in small caps, in regional banks, in commodities, in emerging markets. All of those things are benefiting from a weaker dollar, which is coming from Fed expectations and hopes that the Fed will be enough for the consumer. And I think it's a big question mark. Does the transmission mechanism from the Fed to the consumer work this time? Remember, about 60% of U.S. mortgages right now are locked in at 4% or less. So even when the Fed starts to cut rates, you're not going to see a bunch of mortgage resets that create consumer wealth overnight. So yes, there's going to be transmission to the equity markets, to wealth that way, but it's not going to be the normal channels we've seen in decades past. So it's a question to me, can they get the soft landing? I'm still on the fence about that.
How much transmission, though? Because you think about it, and fine, maybe some of that cash on the sidelines might move to equity markets. But given how much big tech, AI, NVIDIA has been propping up this market, if you still have weakness in the consumer and the sector lags, can you really see significant gains in the S&P?
I hear you. I mean, personally, I'm structurally bullish on tech. I appreciate that the valuations and the crowded positions, less so today, but still there, make those stocks vulnerable to any disappointment. Even if revenues beat, if guidance is soft, you can still get some pullbacks. That's important. But longer term, these companies have such a comparative advantage, incredible free cash flow. They have the ability to invest in themselves and continue to innovate. So if I see a dip in those stocks, I'm a buyer. I want to stay invested. But for the consumer, things like small cap, that rotation, it's not enough to have lower rates. You also needed to see stable or ideally improving growth. I'm kind of skeptical that growth's going to improve that much just on the back of the Fed cuts.
Well, let's keep the conversation going specifically on big tech, because we have NVIDIA reporting after the bell tomorrow. You take a look at what's priced in, about a 9 to 10% move. That's in line with historical averages, and it just feels like, compared to maybe 3 months ago or their earnings report before that, when it was billed as the most important thing to ever happen, there's a little bit less anticipation, a little less fanfare around this one. What can we take away from that, extrapolate out from that when it comes to the mood of this market?
I think part of the less myopia on NVIDIA is because we've had a bit of a rotation already. If we look at the month of August, we have seen things like the equal-weighted S&P do significantly better. So people have been broadening out their positions across sectors, across types of stocks, and I think that takes a little bit of the onus off of the single magnificent 7 names, if you will. It's still going to be important, obviously, in a low liquidity environment this week. If they have a strong or a weak result, especially on the guidance, it's going to move the market for a day or two. Again, my view is keep an eye on the bigger picture. Do we think AI is going to continue to broaden its impact? Do we think, in this case of NVIDIA, the demand is going to continue to outstrip supply for its key chips as we go into next year? That was their guidance at the last report they made earlier this summer. Let's see what they say this time.
If you take the last month as a sampling of that broadening out trade that we're talking about here, you see consumer staples, you see real estate, you see utilities really leading that list here, some of the dividend payers as well. Is this indicative of the type of broadening you might see through the rest of the year, or is this just a short-term play on potentially lower rates?
Right, and well, lower rates I think we're going to get. The question is, do we get as much or more than is already discounted? The thing that I'm more skeptical about is the other piece of the soft landing, which is, are we going to see a strong consumer continuing to support earnings? Utilities is kind of interesting because it can also be a defensive play. If the consumer pulls back, the AI story remains intact. We continue to need more energy. So that's something that probably is a little more perennial, if you will. But some of the other consumer plays, again, especially going into things like small cap or regional banks, I think they really require better growth, better consumption data in the quarters ahead. It's not clear to me that the Fed cuts will be enough to generate that.
That's interesting, and of course you're sticking with us, but before we go to break, I wanted to talk specifically about size. That was, a beautiful chart showing us the broadening out among sectors, but when it comes to the small caps, I'm glad you brought them up because that's one of the debates, whether Fed cuts will be enough. And, you talk about this path down to neutral, but there's the idea out there that neutral is higher than what it used to be.
Absolutely. I think it is, without a doubt. And so what I think often happens is investors will look at historical patterns and they'll say, okay, when the Fed started cutting interest rates, that was usually close to the bottom for the economic cycle, the business cycle, and small caps, because they're less liquid stocks, tend to move faster as we go through that turn in the beginning of the economic upturn. But we're not in that place right now, right? We're not in a recession. We're actually in a decent economy. And so are we going to get the turn in the economy with the amount of force that you would in, say, a 2009 or even a 2001, 2002? It's very different this time with the consumer and with everything else. The one thing small caps have, incredibly cheap still today valuations, very underowned. So it's worth looking at them. I just don't know if the growth catalyst is going to be there. So my view has been, continues to be, don't ignore them, don't avoid them completely, but this is a time to be active management, very selective. I would not be buying a broader small cap index, broader EM index, any of those soft landing plays. You need to be stock picking right now in those areas.
All right, Rebecca, we're just getting started. Sit tight for a couple minutes. That, of course, is Rebecca Patterson sticking with us. Let's take a look at futures right now. Of course, as losses deepen pre-market, the S&P down about 0.3% pre-market. The NASDAQ 100, your big tech names, down about 0.4%. And that rotation that we were talking about, not exactly happening today. The Russell 2000 futures currently down about 0.8%. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before. and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Now to high interest, a look at what's making headlines around the world. Longtime Apple CFO Luca Maestri will step down from his job at the end of the year. He will be replaced by his top deputy in what's being described as a planned succession. Maestri will remain at Apple in a reduced position. And remember, Apple also announcing its latest product launch event on September 9th, expected to announce details of the iPhone 16. And Eli Lilly is now selling vials of its blockbuster weight loss drug Zepbound to patients for a discount as it tries to address supply shortages. Patients with a prescription can purchase a month's supply of single-use vials through Lilly's website starting today. Zepbound is sold as an auto-injector pen. With vials, patients need to fill syringes on their own, but it saves Lilly production time, allowing more patients to get the drug. And Meta CEO Mark Zuckerberg alleges that Facebook was pressured by the U.S. government to censor COVID-19 content during the pandemic. In a letter sent to the U.S. House Committee chair, he said senior officials, including some from the White House, had pressured Meta to remove content in 2021. Zuckerberg joins other social media executives in lamenting past instances of content moderation that, in their view, went too far. Katie.
And we're back now with Rebecca Patterson, former chief investment strategist at Bridgewater Associates. And let's stick with politics because we've talked about the Fed, we've talked about earnings, and you were actually at the DNC last week. Tell us what the vibe was on the ground.
Yeah, so I was invited to speak on the sidelines of the convention about economics and policy. And, you know, just like you all want to talk to your sources, security analysts want to go talk to company management, this was an opportunity for me to be on the ground, to talk to policymakers, talk to executives, and get a better feel of what kind of policy we could get if Harris does become our next president. What struck me more than anything about this event, and this was the first convention I've ever attended, was the amount of very senior level corporate interest in the policy proposals of a possible Harris administration. It was much more business forward, business friendly than I think sometimes the mainstream media might portray it.
So to that end, you did have Harris initially put forward this price gouging ban. There are a lot of worries among the C-suite here that the taxation policies will be much more stringent, particularly as those Trump-era tax cuts expire. Why exactly do you see a path in which she might be more friendly to corporations than meets the eye?
Yeah, so the price gouging proposal, it's important to note that price gouging bans already exist in 34 states, so this isn't anything new, and it's not clear to me exactly how it would be implemented, if it could even get passed. I think the bigger picture here for Harris, and this is just my own speculation, is that they're trying to do what they can to help families that have not participated as much in this economic recovery. And a lot of that is prices. So what can they do to increase supply of homes, to reduce home prices possibly, or make it easier for those people to buy a home, to make sure they can afford their groceries, et cetera. So how often are they going to implement price gouging? Maybe never, given that grocery prices are now starting to come down a little bit. But it's just a signal of we're out there, we're trying to take care of you. But I think the more important thing I heard, you know, when we think about taxes, when we think about investment,
What I heard from policymakers and people thinking about policies for Harris is really a pragmatic approach. What do we need to do to take care of the economy and everyone in it? And so, yes, we may need to raise taxes because we have this incredibly large debt and deficit thing hanging out here. So we can't just have unfunded tax cuts. But anyone with an income 400,000 or lower is getting tax cuts or no tax increase. So there's gives and takes. I think the big takeaway from me is that when we, you all reporting, me investing, researching this, look at this, don't take any one policy in isolation. And I know you don't. We have to look at the aggregate picture. So price gouging is this one tiny little dot that people make a big deal out of, but you have to look at the policy platform in aggregate, and then remember that policy is one part of the picture. We also have to think about monetary policy, growth outside the United States, and what's happening at the bottom-up level. What are companies doing? What are industries doing? All of that is going to tell us how to invest, not any one given policy.
Well, I want to extend the timeline because, some of the conversation about how the candidates relate to markets can be very short-term in nature. We talk about the Trump trade, we talk about the Harris trade, but when you consider their policies holistically, what they've put forward so far, how does the Trump investment differ from the Harris investment landscape?
One reflection I've had as I spend as much time as I can understanding how their policies, if they get enacted, could affect the economy and markets is that in general, and this is a generalized comment, I find that a lot of the Republican proposals are broad, blunt tools, broad tariffs, broad tax cuts. And that's neither good nor bad, but they're hoping that this broad approach will get the result they want. The Democrats tend to be, instead of a sledgehammer, a scalpel. We want to make investments, but we don't want to spend more than we have to given the deficit. So let's give money to strategic industries where we need more secure supply chains, where we know we can create manufacturing jobs. And so there's different approaches. The tricky part with the scalpel approach, for example, the Inflation Reduction Act, the CHIPS and Science Act, is for those things to lead to economic growth and jobs takes years. Right? It's no sugar high for a manufacturing worker or the economy, whereas I'm cutting taxes by this much this day, that's a sugar high. And so there's going to be differences in how quickly you feel the changes, and there's going to be differences in the unintended costs and risks from the two policies.
Well, Rebecca, I'm going to ask the cheaper question here because we could think about those long-term investments, but there's so many people out there trying to understand the trade.
Yeah.
How do you wrap your head around the Harris trade?
So I think for shorter term investors who are saying, okay, we're getting close to November, how do I position for that? First of all, don't position till we're in October. 70 days or so we have left till the election is a lifetime. A lot can change between now and then. So I would not be positioning yet. I would be thinking about scenarios depending on who might win, Trump, Harris, and the possibility we don't know the winner or the congressional makeup for maybe a few weeks, especially on the Congress side after the election. And so you don't want to put all your eggs in one basket. I would be looking at policies between the two candidates that are likely to work either way. So for example, something like defense, bipartisan support to keep defense spending going. Something like energy. Now, Harris is much more focused on clean energy, but they're not giving up on fossil fuel. They can't, right? For us to make that transition smoothly, you're going to need fossil fuel for some time. So, and natural gas is a cleaner fuel in that front. So I think that there are sectors that are likely to play well, almost regardless who wins. If I were going to do a shorter term trade on the election, that's what I would be doing right now, trying to find those small slices where the two candidates' policies actually have something in common. And there are a few of those places.
And wait until October.
Oh, gosh, yes. Oh, my gosh, yes. It's way too, think about Hillary Clinton. Until October, people thought she was by and far the winner and she was going to beat Donald Trump.
Yeah.
And everything changed in a matter of weeks. And people who bet on one outcome too early got burned. Likewise, Donald Trump, everyone thought trade war, it's going to be horrible for the U.S. economy, horrible for the U.S. stock market. That trade lasted a few hours. Right? So you need to be very careful not to overplay the trade regardless of who wins and what their policies might be.
be having to have you back a lot more closer to that date. Former Bridgewater Chief Investment Strategist Rebecca Patterson, we thank you so very much for your time. Also bringing you some breaking news because Supermicro shares are dropping 8% pre-market on a Hindenburg short. Hindenburg posting on their X page and their website, Supermicro, providing fresh evidence of accounting manipulation, sibling self-dealing, and sanctions evasion at this AI high flyer. Remember, Supermicro is a stock that has risen about 100% this year ahead of this short being announced. Stick with us. This is Bloomberg. We'll bring you more as it comes, including their response if they have one.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture,
covering the intersections of Hollywood, Silicon Valley.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's time now for Social Climbers. The company's making waves this morning. And first up, Leslie's announcing a new CEO today. Jason McDonald will succeed the former CEO who left the pool and spa retailer a little over a month ago after the company cut its outlook because of difficult industry conditions. Now, that weakness was due in part to unfavorable weather this pool season and the impact of high inflation. Next up, former President Donald Trump says that he would put Tesla CEO Elon Musk in his cabinet if Musk has the bandwidth. In an online interview posted yesterday, Trump praised Musk as a genius and said it was more likely that he would involve the Tesla CEO as a federal cost-cutting consultant. And finally, NFL brothers Jason and Travis Kelce today reaching a deal worth more than $100 million with Amazon for their New Heights podcast. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Shonali.
And a quick check on futures here before we head to break, because of course ahead of this market open, you do have S&P futures sinking around 0.3%, more so for NASDAQ 100, down nearly 0.5%. Same too for the Russell 2000, down 0.7%. Stick with us for the open. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar, they're leaders in EVs, they're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries, and those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
All right, we are moments away from the start of trading. Of course, as we wait and see for NVIDIA earnings coming up tomorrow, you can see futures right now a little bit depressed. We had a rough day yesterday. Looks like it will continue today. Of course, the S&P 500 down about 0.3% pre-market with just seconds to go until those bells officially ring and the market opens. You can see on the NYSE, we have ING Academy on the NASDAQ. It's a community bank from Ohio. We're thinking of Matt Miller, Middlefield Bank, ringing the bells. Of course, as we kick off trading on this Tuesday, you take a look at where markets are opening up. You can see the S&P 500 down 0.2%. Big tech, those are yesterday's numbers, but you can see they were falling at 1% yesterday. And as markets open right now and the board flips up, continuing that downfall today, down about 0.3%. And the Russell 2000, not too pretty for those small caps, currently down about 0.5%. But one stock specifically to keep an eye on right now, shares of Paramount falling. Skydance set to become the new owner of the media conglomerate. That's after Edgar Bronfman Jr.'s group dropped out of the bidding war after submitting a $6 billion proposal last week. Paramount now expects to complete this deal with Skydance in the first half of 2025. And maybe then, Shonali, we can stop talking about it.
Maybe then, maybe not, though, knowing how this has been going. Also watching shares of Supermicro also dropping. Hindenburg says it's shorting the company. Bloomberg is reaching out to Supermicro for comment. Supermicro now down more than 7% at the market open. We're also watching Cava because the restaurant chain's largest individual shareholder and a group of executives filed to sell shares. And remember, Cava has been on a tear this year. And since last week's earnings, 10 analysts raised their price targets by an average of 23%. Yet on that share sale, you have Cava now falling more than 7% this morning as well. Let's take a closer look at Cava with Bloomberg's Abigail Doolittle.
And this is the worst day for Cava, Shonali, going back to February of this year. So some significant selling, lots of mixed messages around this stock and the company. Now, if we take a look at the sale, I think that one reason that investors in the stock, retail investors, institutional investors are concerned about our tail selling. They actually sold a pretty decent chunk back in June. They sold 3 million shares. That was worth about $267 million. Well, now they filed to sell 6 million shares. That's about 8.6% of the equity float. Into this, holding about 20.5% of the equity float, so a pretty significant amount. Investors wondering what's going on here. Are they really shaving? Plus, there were some of the executives within Cava itself, the Mediterranean fast food company, company, including CEO Brett Schulman, did also file to sell shares. However, before we start feeling too bad for investors in Kava, although it does, of course, depend on where you bought, if we take a look at these shares out of the IPO, this is really pretty incredible. So we think that of NVIDIA as being parabolic. If we go back to Kava's IPO all the way back in June of last year, in white here, even with today's dip, and technically this does not look good, this is a parabolic uptrend, the reversal. We will reverse it all the way well back below 400. Remember, 90-degree angle can't hold. But there is NVIDIA in blue, and actually above that, sweet green, and then Chipotle down in yellow. So some of these newer restaurant companies, they're taking on the AI craze, Katie.
All right, there you have it. Abigail Doodle, thank you so much. And let's broaden out this conversation now with Dana Dioria. She is Co-Chief Investment Officer over at InvestNet. And I want to go to your notes because you write that earnings are cooperating, but the only notable company that is yet to report, of course, is NVIDIA. And that feels like a big but, to put it mildly, Dana, because NVIDIA, I mean, second largest company in the S&P 500 by market cap, move of 10% priced either way. What do you think the stakes are when it actually comes to this company?
Yeah, also a huge contributor to earnings, right? For the overall S&P, I mean, close to 5% contributor on the earnings side. So yeah, there's no question that, you know, we're past the FOMC meeting. That was sort of the big market moving event that we were expecting. But the NVIDIA announcement coming is certainly going to be the next one that we can look toward. And, you know, it's not just about, of course, NVIDIA itself, right? And the earnings contribution and, you know, its market cap weight. It's, of course, you know, a bellwether on how the AI trade is going. And we're seeing lately a little bit of a pullback on tech, right? The equal weighted index doing much better. And so I think, you know, there's going to be always an NVIDIA, not only for the company itself, of course, but just for how well are we doing in this AI trade.
When you think about some of those big tech earnings that didn't go over so well in early to mid-July, and one of the criticisms, of course, was that basically they're spending so much money on AI and not getting anything back. But then you take a look at the companies that are taking in that money, and it's NVIDIA. I mean, 19% of their revenue comes from Microsoft alone. So those billions of dollars that are being funneled to AI, that just feels like NVIDIA's benefit here.
It is. And right now what we're seeing, of course, is that the AI craze is really sort of focused on the creators, right? If you will, the NVIDIAs of the world who are going to deliver us the components we need to use AI. We haven't yet seen AI in any way kind of break out into or user experience, right? And how, you know, big companies pointing to our productivity increased dramatically. You get a lot of talk of AI in earnings announcements, and, you know, just for the sake of, hey, we're looking at this, or we've experienced some benefit here. But there's big differences in how companies are using AI, and we have yet to see a really big move in terms of just, you know, productivity increase or efficiency increase, or, you know, the benefits of AI to the users. And that's why so much towers on the NVIDIAs of the world now. But, you know, these big tech companies investing here, they're self-funding, right? They can certainly afford to accept a little bit of a dip if they see the long-run thesis, and clearly they do.
You know, it's interesting. We had a conversation with RBC's Amy Wu Silverman just a day ago, and she made this point that there has been such extreme bullishness in NVIDIA that even a little less bullish means that it could say a lot for the market, that people are excited, but maybe not as excited as they were when valuations were a little lower or when the market was a little less choppy. Now, at the end of the day, if that's the case, then is NVIDIA really a story that could prop up more boats and lift this market higher with it?
I think if NVIDIA does well, it does lift boats for sure. You know, there's two things going on here, right? There's the short run. How is NVIDIA doing in this moment relative to expectations? How does the market perceive that? And when your valuation is so high, any little bump, 100%, right? In the short run, any little bump is going to be negative, not only for the stock, but for the market overall. That's a very different question than what is the long run thesis for AI? Are we well on our way? Is NVIDIA one of the companies, not the only company, but one of the companies that's going to get us to this huge revolution, right? And change in how we all do business. So, I mean, you know, the short run, absolutely. You know, they got to hit it spot on, right down the middle in terms of, you know, the pitch, right? But at the end of the day, this is just a short run kind of a market, you know, assessment of have we overshot right now? It has nothing to do with the long run thesis here.
Well, that was my question. Why not wait? It's interesting. If you take a look at the Philadelphia Semiconductor Index, for example, just year to date, NVIDIA up more than 150%. It's really up 154%. To get to the next best performing stock, it's Coherent at about 80% on the year. Why not either look for stocks that are sitting at lesser gains, better valuations, or just wait for a steeper downturn to get in?
I think that is the right thing to do for the average investor, right? I mean, I think the average investor is, they're either, if they're passive, they're getting a ton of NVIDIA. Even if they're active, unless they're taking massive tracking error to the index, they have a whopping amount of these types of companies, NVIDIA's and, the big tech in their portfolios already. So 100%, and as we see the equal weighted S&P making new highs, all the more reason that, what you're asking, I think, is 100% valid, that for the average investor, tilting away from this a little bit is probably the smart way to go, even if you believe in the long run AI thesis.
Dana, we have to leave it there. That's Dana Dioria of InvestNet. We thank you so much for your time ahead of a very critical set of earnings this week. And of course, there's a lot of economic data this week as well. Now, coming up, we're going to talk to Bob Sloan from S3 Partners to discuss the market implications of NVIDIA earnings tomorrow. We're going to also talk about the market for going short here because, of course, you have some prominent names betting against some high flyers. We're going to talk about it next. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. A quick check on stocks because we're having a tough tape today. We are seeing the S&P 500 holding on to losses today of 0.3% and deeper declines in the NASDAQ 100 of 0.6%. That small and mid-cap index, that Russell 2000, the once beloved index this year, now seeing some pain as well, 0.7% lower. Really that optimism around interest rate cuts fading in the market today, Katie.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Citi says to sell Hershey, downgrading the chocolate maker from neutral and cutting its price target. The analyst sees a challenging year for Hershey and says that its pricing plans for next year won't be enough to offset the high cost of cocoa. Next up, you have Seaport raising Cleveland Cliffs to buy. The analyst says that the firm is well positioned to respond to a down cycle in steel prices and adds that the upcoming conferences will improve sector sentiment. And finally, we have Morgan Stanley raising its price target on Coca-Cola to a street high of $78, naming it a top beverage pick as well, replacing Pepsi. The analyst says the soda giant is posting healthier volume growth than its peers and highlights the company's strong pricing power, Janali.
And all eyes on NVIDIA this week ahead of earnings tomorrow. S3 Partners founder and managing partner Bob Sloan joins us, and his team notes that NVIDIA remains one of the largest positions in both the long and the short side of the market. Actually, the most shorted semiconductor stock with over 4 times the short interest of Broadcom. You write, Bob, tell me about this data that you're seeing here. What exactly is driving the short interest here? Do you understand if it's really about valuation concerns mostly? And do you think that short interest is sustainable given the run-up we've even seen this year?
Well, one of the things we've seen in our short interest data is the following. Shorts started the year at $13 billion. They're now at $35 billion. New initiated shorts along the way of $3 billion. So you have the most new initiated shorts in the semiconductor sector, NVIDIA, $3 billion. The largest by far, both in the sector and across the industry and across the entire market, total $35 billion. Persistence of short selling and new initiation equals high conviction. And I think the analysts that you've had on your show, I was watching yesterday and today, have been talking about a near-term momentum reversal. That's what the short interest is betting on.
And Bob, of course, NVIDIA has become more and more important to the market, of course, as that AI story really takes hold and this company becomes bigger and bigger. How does the short interest dynamics against the long side that we're seeing ahead of this earnings report compare to previous quarters?
Katie, it's a great question. So for the first time really ever, you can, by using our data, you can break down market structure. Now, who cares about NVIDIA? Everybody. If you're a passive investor, it's your second largest holding across the market. If you're an active long manager, it's your third or second largest holding across the market. If you're retail, it's probably your largest holding. If you're a short seller, it is the largest holding, largest bet. So everyone around the table has a stake in NVIDIA. And what our data is telling us is that the long holders are trimming just a hair. Just a hair. The passive investors are trimming by about 2%. The active managers about 7%. Short sale sticking in. So you see a little bit of long selling, persistent short selling, and that's why we think the market's set up for a near-term momentum reversing. These stocks are unicorns. NVIDIA, you don't see this very often where it's the largest long position in the marketplace and it's the largest short position. So it's happened maybe like 4 or 5 times in the last 30 years. And the reason why is because it's this incredible utility combination of high beta, high vol, high liquidity, and cheap to get in and out of, both shorting and long.
Bob, you know, one thing we were talking about a little earlier as well that I'd love to get your insight on is NVIDIA has risen a lot more than what you've seen in the rest of the Philadelphia Semiconductor Index. So when you look at investor attitudes towards other AI-related companies, given the run-ups we've seen in many of them, do you see similar levels of short interest outside of NVIDIA?
NVIDIA dominates It's a third of short interest in the semiconductor sector, and it's the largest short, period, across the marketplace. The rest are just add-ons.
And it's interesting, of course, that dynamic that we've been talking about, that you have interest both on the long side and on the short side. You're seeing it too if you take a look at some of these leveraged single stock ETFs. You have shares outstanding both in the 2x long and in the 2x short products. So it's interesting to see that match up with your S3 data as well. And one of the narratives I remember, especially around Tesla, was that it's impossible to short. You just get burned and burned. How much money, just roughly speaking, have short sellers actually lost when it comes to NVIDIA?
Yeah, about $22 billion. And
wow.
So that's a great point. It's about high conviction. Taking losses, but taking the pain and staying in the trade. And not, usually you see, with the Tesla, the difference was that you'd see older shorts get replaced by newer shorts and get taken out. We're not seeing that. There's a real persistence. And, you know, there is some, I would say, maybe market euphoria is having dessert and it's calling for the check.
Bob, thank you so much for joining us. That is Bob Sloan of S3. And don't miss an exclusive interview tomorrow with NVIDIA CEO Jensen Huang right here on Bloomberg TV at 6:30 p.m. Eastern. And coming up, we're going to talk about IPO hopefuls. They're facing a tough choice. Take the leap and go public this fall, or wait until next year when risks may subside. We're going to discuss the dilemma next. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
All right, this is Bloomberg Open Interest. Let's take a quick check on stocks right now. Companies are itching to go public, but the market hasn't exactly been fruitful for that. You take a look right now, the S&P 500 down about 0.2%. The NASDAQ 100 even more, down about 0.4%. That's after yesterday's slide, of course, down nearly 1% yesterday, continuing to fall today. And the Russell 2000, things are getting ugly over there in small cap land, down about 0.7%. Of course, we're in that interesting vacuum, Shanali, after Jackson Hole, but before NVIDIA earnings and, of course, before the Fed's September meeting.
There's another window we're going to talk about also. It's that IPO window, because companies itching to go public face a really tough choice here. The fall IPO window is now open, and you can either take the leap with markets near all-time highs or wait until next year when risks around interest rates and the U.S. election have faded. For more on this dilemma, we're joined now by Bloomberg IPO reporter Bailey Lipschultz, who has been writing about this dilemma all year long, and you look at what has happened this year so far. The companies that have gone public, even the ones that have hit potholes along the way, are still higher than their IPO price. Why not just take the leap right now?
Well, that's the big argument, is why not? If you look at Viking up 50%, you look at Lineage, the biggest offering of the year, raising more than $4 billion in the REIT space, up about 10%. Investors are being rewarded, but a lot of founders and boards raised cash in 2020 and 2021 at far higher valuations. So now you have to have that conversation about what are we actually worth and what kind of a discount do we need to give investors to buy the IPO so that we can talk about being up 40 or 50% as opposed to being, you know, like a company that's like Rubrik, which is up 11%, even Astera Labs, who went public last year, which is closer to unchanged after almost doubling in its first day.
And so I get the thinking that, okay, if we're not going to go public by November 5th, maybe we just wait until next year. But you think about some of the risks on the table. Do you think that the landscape will have meaningfully changed in 2025? What's the logic there?
Well, when we sat down with the heads of pretty much every bulge bracket bank last year in November, the conversation was, you know, 24, we're going to have 4 or 5 rate cuts. We're going to have some election risk that'll eventually kind of play itself out. It feels like we're having that same conversation. Yes, there is a timestamp for the election, so we will most likely be kind of moving on from that risk come January, February, and we are expecting, as you guys have kind of talked about, the Fed to cut in September, and potentially, at least when you look at the swaps market, potentially the next 5 meetings. But the big question is, will those interest rate cuts play out? How will investors react to a potentially riskier environment? And how does that impact some of the valuations that a number of these companies that have been waiting to go public, trying to kind of tease out what their actual valuation would look like? Their view is that they'll have a better kind of line of sight come March to May.
You kind of have to also think, I think, about who benefits if you kind of go public at top dollar, right? I mean, there's certain investors who do benefit, but plenty who don't. A lot of employees have stock in these companies that want to continue to see those companies do well. Is there a benefit, actually, to wait and see if valuation's correct?
Well, it really depends who's selling, and there is kind of just that argument that taking a perceived down round can hurt some egos and hurt some expectations, or even just hurt morale. If you raise cash and you're an employee and you are worth $60 billion and you go public at 20, then you're looking at your options saying, well, this isn't really what I signed up for. But on the flip side, if you go public and only sell a small chunk of your stake, in 6 months from now, if you're a private equity sponsor, you can start capitalizing. Or if you're a company like Kava that's up 400%, that's a still hefty return that maybe when you went public at the IPO, you weren't as excited about that price and valuation, but if you continue to execute and don't have missteps, you're going to be looking better in the end.
All right, Bailey, like 45 seconds. We're talking, of course, a lot this year about that dearth of IPOs, but I thought this was interesting under your byline this morning, a SPAC. I haven't heard that phrase in a while. Yeah, let's talk about it.
Yeah, so Bob Diamond and Concord had launched 3 SPACs. This is the last remaining pre-deal SPAC, but no more, announcing plans to take Events.com public. So Bob Diamond, former CEO of Barclays, a lot of excitement around that name, and his firm Atlas. So this deal, which we broke overnight, is going to value the company north of $300 million, depending how you want to tease that out. But another SPAC deal in what's been a really boom or bust, primarily bust space in the last few years.
All right, Bailey Lipschultz, really appreciate you stopping by. Of course, he covers IPOs, equities, and everything else. Let's get you to the trading diary. What you need to be watching this week today. We get Nordstrom earnings after the bell, really kicking off a string of retail earnings this week. But the big event is tomorrow, of course, when we get earnings from NVIDIA after the bell. All eyes on those numbers. More retail earnings from Kohl's, Abercrombie & Fitch, and Five Below coming up on Wednesday as well. Thursday, initial jobless claims, and Friday, we get July's PCE inflation data. Now, coming up in the next hour, we're joined by Zillow's new CEO, as well as Mark Patrikoff. That's, of course, as the NFL votes on private equity ownership. This is Bloomberg.
sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. I'm Alex Steele. Paul Sweeney is at the U.S. Open, probably lived there for the whole day. Bailey Lipschultz from the equities team will be joining us for the next 2 hours. Bailey, thank you so much. Really appreciate it. I know. It's okay. I'm going on Thursday, so bye. This is my Friday, so don't feel too bad. All right, we are going to have a great show for you. We're going to break down all the economic numbers that we're just crossing at the top of the hour. We're also going to look ahead to some of the auctions. We get 2 years, we get 5 year, we get 7 year this week. Ira Jersey, Bloomberg Intelligence will be joining us. Plus, get the broader view on what to do with the markets headed into NVIDIA. Kathy Entwistle is Managing Director at Morgan Stanley Private Wealth Management. Is NVIDIA a market event, or is it just an NVIDIA event at this point? Plus, it looks like Skydance finally got the win, finally for Paramount. Geetha Raghunathan of Bloomberg Intelligence will be joining us on that. So we got you all covered for the next 2 hours. In the meantime, here's a business flash with John Tucker.
All right, Alex, we are confident. Apparently, the Consumer Confidence Board, the Conference Board's Consumer Confidence Index, higher than expected, 103.3. That just crossing the Bloomberg. The expectation was for something around 100.7. Also, the Richmond Fed, the manufacturing index, that continues to decline, down 19 points. As far as stocks, volumes pretty anemic right now. Traders seem to be biding their time until the close tomorrow. Of course, that's when NVIDIA reports. The trading in the options market does suggest investors see potential for a 9 to 10% move in either direction the day following that report. The S&P 500 right now, 7 points lower, down 0.1%, 5610 on the index right now. And after yesterday's record close, the Dow Jones Industrial Average, 50 points lower, but it's down 0.1% right now at 41,192. A supermicrocomputer tumbling after Hindenburg Research said it's short of the maker of server equipment. A Bloomberg gauge of the Magnificent Seven stocks falling about 0.4%. And then the Russell Index, the Russell 2000, the small mid-cap stocks right now today, after yesterday's pop, it is down about 0.9%. Two-year yield, 1 basis point higher. We're at 3.95. The 10-year yield right now, 4 basis points higher. That is at 3.85. And we check markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Bailey and Alec, the camera's moving because we broke the set earlier today. So for those of you on YouTube, it's a new shot.
That's amazing.
Minus the wall.
That's what we do here. We you're so impassioned.
Multi-million-dollar set destroyed in a fraction of a second.
All right. Well, some big news for our New England listeners, guys. You got Bloomberg 106.1 and 1330 are moving to 92.9 FM. That's starting September 3rd. Listen to Bloomberg Radio in and around Boston, 92.9 FM. It is your news source for business news from the financial center of New England. Bloomberg Radio moving to 92.9 FM at noon, the day after Labor Day. Let's get back to the consumer confidence number. Super strong, coming in at 103.3. The estimate was for 100.7. It's a better view of the economy and inflation, it looks like. So we wanted to go right to the source here. Stephanie Gouchard is senior economist at Global Indicators at the Conference Board, joining us. Stephanie, what led the optimism?
Well, so let me get this straight. It's an improvement, but I wouldn't qualify it as a strong improvement. The index is still in this narrow range where it has been for the past 2 years. So that's the first thing I wanted to say. But if we go into the improvement, so what has been driving the improvement is some more positive views by consumers about business conditions right now and business condition in the future. So this is really what has driven the improvement in August.
And looking at the measure of expectations for the next 6 months, it looks like the increase, so that's at an 82.5 from an 81.1, similar increase relative to present conditions. Kind of how do you view the consumer right now, given, 6 months from now, we could have 3, 4, 5, 6 interest rate cuts and an election in the rearview mirror?
So consumer feelings about the economy are really mixed. So yes, their views about business condition improve, but at the same time, if you look into the details, they are getting more concerned about employment, both currently and in the future. So this is it's really a mixed view about the economy. They are still concerned about high prices. At the same time, their inflation expectations have declined. They're expecting rate cuts more than they were a month ago. So some things are moving on the positive side and some things are moving on the less positive side, especially regarding employment.
All right, we really appreciate you breaking that down and, putting it all into perspective for us, particularly the jobs part. It feels like that's very much what the Fed's also worried about. Stephanie Gouchard, senior economist, Global Indicators at the Conference Board. It's interesting. It's like the Fed seems to be pivoting to be worrying about jobs, and it looks like that is very similar now to how consumers are feeling.
Yeah, and it does make sense, as she put it, that it's kind of mixed read, and that's why the S&P is still down 0.1%. I mean, sure, it's summer Friday vibes on a Tuesday, but
we're taking it in stride. It is my Friday, so it is definitely Friday vibes for me. All right, let's get more market drivers here. Market Drivers is brought to you by IBKR Financial Advisors. Switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest. IBKR.com/RIA. It might be light volume, but there's still stuff that's happening. Norma Linda is joining us from Bloomberg News. Okay, you were looking at, first and foremost, Paramount.
Yes, honestly, Paul would love this, but I guess he's enjoying the tennis match right now. But I'm looking at Paramount because of this news that came out this morning. It's saying that Skydance Media is set to become the new owner of Paramount. So essentially, Brofman is out. He's the Seagram heir, as we know. He's ending one of the most dramatic acquisition contests that we've really seen for a while. And we know that Paramount has really been a depressed company, and really with Skydance coming in to swoop in and see what they can do with the company, that's really what's been in focus. Apparently, the deal should be complete with Skydance in the first half of next year, especially with them confirming Bronfman's retreat late this month or on Monday. It also ended its go-shop period that essentially allowed it to look for other bidders. So it seems like this is kind of set in stone here. We're seeing shares of Paramount falling as much as 6% for the worst day since June, but shares are down as much as 28% year to date as I'm watching the chart.
I personally, Alex, I don't know how you feel. The back and forth with Paramount, I was kind of over it. So I was
totally over it.
Give me a headache, whiplash.
You know who's definitely over it? Geetha Ranganathan. We're going to talk to her later on in the hour. I'm pretty sure she has an Excel spreadsheet and is definitely over this situation. But on the downside, Supermicro getting hit really hard, worst performing stock in the S&P. Why?
So this is actually one of our most read stories right now. One of my colleagues, Ryan, wrote this one. And we're seeing shares of Supermicro tumbling as much as 8.7%. Now, this is after Hindenburg took an aim at the company with a short report. Everyone always has eyes on Hindenburg. And when they say something about a company, everyone's watching it. And so we're seeing shares of Supermicro falling because Hindenburg is saying that they've done an investigation that revealed that the company has glaring accounting red flags, evidence of undisclosed related party transactions, sanctions and export control failures, as well as customer issues. Whoa. We haven't heard back from the company yet, but as I said, shares are falling nearly 9% this morning. But if we look at a longer chart, we're seeing shares of Supermicro up nearly 90% this year.
Yeah, I will point out to that point, NASDAQ 100 best performers this year, NVIDIA, Supermicro, and ARM. So all about the AI names, but we're going to see how Wednesday shakes out. You talked about a name that Paul would be excited about. What about a name that Matt Miller would be excited about? Eli Lilly.
Is this his stock? Is this one of his, not his stock, but is this one of the companies that he loves?
Paul knows someone who takes the injection, so he's all into the weight loss drugs. I don't know Matt Miller's jam with it, though.
Matt just, like, every time when he used to
he loves it.
He wanted the weight loss drugs nonstop. That's all he talked about.
I mean, it's all the fad.
Exactly.
It's all the fad. Everyone is watching these weight loss drugs.
Do you think he was going to get high? It's for weight loss.
Maybe eat more gummies. I don't know. Right. Anyway, this is definitely all the rage, but this is a big deal because now it's cheaper, kind of, sort of, in a different package.
Right. And so we do know that Eli Lilly, their main weight loss drug is Zepbound, and apparently they're going to be able to get this drug to patients for as little as $399 a month. It's really been working to overcome supply shortages of this really popular shot that it has, and so essentially patients with a prescription for Zepbound can purchase a month of supply through Lilly's site starting today. And vials were priced at about half of what shots did cost, with a higher dose going for about $549 a month. I mean, $549, it sounds really steep to me, but I do understand that, you know, some people actually do need these weight loss drugs, and there's other people who kind of want to hop on the train, so...
You know that him and
hers,
I think that stock was getting hit because of this news. So like all the compound drugs could get hurt if it's cheap enough for people to buy. But from my understanding, you have to put the liquid in the syringe yourself this time.
Right.
That's why it's cheaper, which I'd be a little scared about, but that's just me.
I guess if you're used to administering insulin, maybe you're familiar with
like
it.
If you actually need it.
Yeah, if you're
for those
the targeted audience.
Right, so for people who actually need it. That's a great point. All right, Nora, thanks a lot. Norma Linda joining us, a Bloomberg Equities reporter. And I mentioned Treasury supply. So Paul's not here, so I can talk about it, and I can think it's cool. So you're looking at $183 billion coming in the next 3 days. You got some 2s, you got 5s, you got 7s, and there's going to be light liquidity as it's the last week in August. Plus, we got past Jackson Hole. So what's that going to be like in the market? Ira Jersey is Bloomberg Intelligence senior U.S. rate strategist, joining us on this. Ira, Paul's not here. We can nerd out. What are you looking for?
Yeah, it's always a crapshoot this time of year. So there's always 2 weeks that you're worried about this month-end supply, right? And it's the last week of August and it's the last week of December because of all the holidays and how many people are on the desk, or are the junior people who are there, were they, what instructions were they given by the senior traders on how to bid at these auctions and how much risk they're allowed to take? So yeah, if I wouldn't read much into it if we do get, some weirdness in some of the auctions this week. But nonetheless, I would be pretty surprised if today's 2-year auction didn't go reasonably well, just because the expectations are for the yields to be lower this time next year, right? And so why not lock in rates near 4% instead of waiting for them to be somewhat lower?
And how does this
kind of play out not only this week with the sleepy end of August, but also looking into September, especially with that highly anticipated Fed meeting, September 18th, ahead of, I guess, kind of the election now?
Yeah, we're priced right now for the Federal Reserve to cut interest rates 100 basis points by the end of the year and cut all the way down to 3% by the end of next year. So I think that what would happen is, in the way that we're priced right now, I suspect that if once the Fed cuts interest rates, that will actually reprice some of the other forward rates. So if, for example, if the Fed were to cut 50 basis points in September, which, given the consumer confidence numbers, that's probably a little less likely now than it was before. But if they were to cut 50, then the question is what gets priced for November and December. And I suspect that either way, if the Fed goes 25 or 50, for the rest of the year, the market will price for just 25 basis point moves. And as it does that, we will actually see some movement in the market, particularly like December futures on Fed funds and SOFR, because if they only go 25, then that means 75 basis points for this year. If they go 50, that probably means 100. So now you have a little bit of certainty. And I think it's getting past that first cut that's going to make things a lot smoother thereafter.
So, Ira, here's my question, though. If rates are going to be cut, and I understand for this particular auction, maybe people want to go in and buy it because they want to lock in a higher rate before the Fed cuts. But when the Fed cuts, are we going to have a supply problem? We've been waiting for that to materialize because of all the supply coming online, but it's been okay because yields have been at 4%. If they go to 3%, do we have a supply problem?
I don't think so. For one thing, the deficits have been reasonably stable. The Treasury Department won't have to increase issuance of coupons probably until sometime in the first or second quarter of next year. So at least for the time being, there's some certainty over how much supply is going to be out there. Plus, you still have a lot of people moving money into fixed income at this point because of the FOMO, right? They do fear missing out. They do fear that if interest rates are lower, that they don't want to miss out on yields closer to 4% than 3%. Interestingly, we don't have 10-year yields going below 3% this cycle, and if they were to go below 3%, that's probably when you can wind up seeing some folks who balk at the relatively low yields. But right now at 3.5%, I suspect that you'll still have pretty decent demand at these auctions.
And Ira, if we could talk briefly about tips, you have a really interesting note on the outlook for tips, just given that inflation expectations and worries are seemingly in the rearview mirror. How will tips and kind of pricing dynamics be playing out, I guess, in the coming weeks and months, assuming we do get this string of interest rate cuts?
Yeah, so one of the things that we noted in there is that piece that we put out yesterday is that the belly of the curve, so the 5-year, 6-year maturity tips, are currently priced for a very significant amount of interest rate cuts, whereas the front end is, yes, they're priced for cuts, but not as dramatically as we're likely that's likely to be realized. So I do think that the belly of the tips curve probably doesn't offer as much value as the short end right now.
Aw, you read his tips note?
I did.
That's so nice. Look at Bailey coming prepared here. That's awesome. Hey, Ira, it might be a slow week here this week. John Tucker's now laughing at me. But moving to next Friday, it's the jobs number. Is the reaction function from the bond market going to be like we saw for the last jobs number and that initial jobless claims read?
I do think so. The jobs number is all that matters right now. If and Jay Powell all but said that at Jackson Hole, right? Like he basically said, like, look, we've now pivoted from only worrying about inflation to having a much more symmetric worry. So therefore, the jobs report winds up being much more impactful to the market. And in fact, if you go back and you look at what's happened the last couple of years and the last 12 months in particular, for any given miss or beat, the job market still moves the treasury yields much more than any other report, almost double what it moves CPI or retail sales, which are the next two major reports that the market tends to move on.
All right, Ira, super appreciate it. Thank you so much. Ira Jersey, Bloomberg Intelligence, Senior U.S. Rates Strategist, joining us there. What are you guys talking about on the equity desk right now? Like if the bonds are going to wait for jobs, definitely an reaction function. Is it about NVIDIA for you guys right now?
It is only about NVIDIA, and it's NVIDIA again, when you think about NVIDIA, it's like, yes, is the S&P 500, the S&P 1, that's a factor because they're so heavily weighted in the S&P 500 and the NASDAQ 100. But when you think about the impact for any chip name, any AI-exposed beneficiary, if NVIDIA crushes earnings again, then everything's kind of to the moon. But if we do see any kind of tempering of expectations from management, that could mean some of those cracks are starting to show that people have feared.
Or what if the report's fine and then it just kind of the stock bumps along and trades nowhere? What does that do to the market? Well, is that a good thing?
I think that's fine. I mean, we saw the stock basically trade flat last year
That's
in
right.
August in 2023, and things turned out pretty okay.
Okay, fair enough. All right, we got lots more coming up. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management, will be joining us. Her outlook from the market, how she's going to be looking at NVIDIA. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. And wait and see mode. The major stock averages lowered a little change as we wait for NVIDIA earnings after the close of Wednesday's trading. Volumes right now pretty light, anemic, we'll call it. 6 of the 11 major industry groups in the S&P 500, they're down. Consumer discretionary is the biggest drag right now, and that's where you're going to find Tesla, down over 2.5%. The worst performing stock in the S&P 500, that belongs to Paramount Global. That is down close to 5% after Edgar Brockman Jr. dropped out of the bidding for the meeting company. And Super Microcomputer, those shares tumbling. Hindenburg Research said it's short of the maker of server equipment. Right now, the S&P 500, 3 points lower, 56.13 on the index. After the record close for the Dow yesterday, it is right now down 35 points, 41,204 on the index. And the NASDAQ 100 is down 15 points. That's a decline of about 0.1%. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tuck. Can you see the new wall? That's
Sure.
how quickly we work.
Are we calling this a wall?
Well, it's more like a banner.
It's a banner.
But it looks better than a broken wall.
I don't think they want us to actually talk about this on air.
Oh,
I think
okay.
This is sort of point of
forget
pain.
I said that then.
All back to
Bailey and
normal.
Alex, let's just change the
And
subject. Move on. Move on.
Okay.
Forget it.
You got the equity market doing a whole lot of nothing. Volume also quite light as well. What do you do when you wind up having NVIDIA? And you also have the jobs data next Friday, and liquidity is just going to be super light at the same time. All right, let's get a professional view. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management, joins us now. Kathy, you're private wealth management, right? Like you're looking for the longer term. You're not a trader. Yet how are you looking at the results on 4/20 on Wednesday afternoon when NVIDIA comes out?
Thanks for having me, Bailey. Great to be with you both. I would say, look, at any time you've got a company that has, or any sort of companies that have an edge in their industry, you have to consider that for the long term as well. So I would say, in terms of people who are holding the types of stocks that are coming out with earnings today that might have special access to parts of the market, or technology that other companies do not, that's important. And listen, if you own it, or any company in an IRA or retirement account, it's easy to sell it and take your gains off the table because you don't have any tax consequences. You really have to think about that when you own it in an individual account. So that's something that we think about when we're thinking about our clients with their long-term view, and also how to leg out of positions as well as leg into positions.
Well, how are you positioning for and advising clients to position for this AI wave? When we look at, obviously, NVIDIA, the most important company in the U.S. market, if not the global market, but we have Supermicro, we have ARM, we have Broadcom, you name it, that are either beneficiaries or have some exposure to a print that not only will move the stock in the market, but all of these peers.
Yeah, so for companies that I think are going to, do well for the long term and have a competitive edge, I would say holding it in retirement accounts is probably a better way to go at the moment because of the large tax implications when and if you need to take it out. You shouldn't be a trader. You shouldn't be going in and out. People don't realize what that does in terms of the tax impact and how it affects your overall profit margin. So in terms of that, yeah, I want clients to have access to AI. And it's not just the companies that are providing AI, but it's the companies that are using AI as well. Right now, the market has, had quite a run up, and we want to be more cautious. We're a little bit more underweight on equities as a whole. And we're also, trying to keep people away from the quote unquote overindulging in, the top 7 or 10 stocks that are out there. But at the same time, it's very hard to do when we see some of these companies running up. So it's a balancing act, and it's important to really think about how that affects, your full portfolio and not just one part of it. I always say never put more than 5% of your assets into one holding anyway. So you want to really be sure that you're not overextended in any one stock.
So you mentioned that it's not like you were crazy invested in the equity market. What is your allocation right now?
Well, I don't take clients out of their equities that are in there for the long term unless there's a specific reason why we're doing so. So I'm typically looking for clients to have 50 to 60% in equities, to have 20% to 25% in taxable accounts, municipal bonds typically, and the balance in some sort of alternative investment. There's a lot of liquid investments, alternative investments available now to clients, and I've heard a few times today people talking about the bank stocks and banks in general, and basically, with all of the regulations that are out there, we're seeing a lot in the private market come in and take over for some of that credit access. So it's interesting too.
And when you talk about some of those alternative investments, a little bit more detail on that. Are you talking about like, privately funded companies investing in hedge funds? Like, what are those opportunities like?
Different opportunities for different people, different, levels of sophistication and also of wealth. So you want to make sure that you're targeting your asset allocation and the actual implementation according to that client's particular situation. But generally speaking, I would say I'm talking about private equity, private markets, different types of private credit, and there's ways for clients. They've democratized it in a sense, alternative investments, and the industry has created investments that are now accessible to clients that were not accessible 2, 3, 4 years ago. So that's very interesting, and it's a great way for individuals to add differentiation into their portfolio, non-correlated assets, and I'm a big fan of that.
When you take a look at what the Fed will or won't do you care in your investor allocation whether it's 25 or 50 in September, whether it's 75 or 100 this year, or is the moment for you just when they start doing it?
No, I care ahead of the game. Okay. I think that perception is really baked into the numbers, and if you don't start making some moves ahead of the decisions, you'll probably miss out on a big opportunity. And for example, municipal bonds still look really attractive right here. At some point, they're going to become less and less attractive as those rate cuts start to happen. So for clients with cash, I am putting them in municipal bonds, not legging in, and trying to get them in as thoughtfully and as quickly as possible, because I think that's a great opportunity for clients right now.
Do you think the market's ahead of its skis when we're looking at 6 cuts being priced in between now and March?
It's possible. It will be interesting. I think we're definitely getting cuts, this year. We are expecting cuts this year. We're expecting about 3 cuts this year. And then I would say I would just take a pause and see what's going on, the reaction, what the Fed is saying. But it is likely that we could have those cuts as well. And again, with the economic environment, political environment, everything that's going on, there's a lot at stake in terms of your personal portfolio and your individual wealth. And we really want to be mindful and thoughtful about that for clients and make sure we're addressing it and we're discussing it.
When you're talking to clients right now, what are they asking in relation to the election?
Just basically, is there a way to position the portfolio one way or another based on like what the potential outcome would be? And I think, certainly overall, clients are already invested. Like clients are invested, and we don't want to make any huge moves ahead of the election. We can make some thoughtful moves. I think minimizing tax impact for clients at any time, regardless of who is running the country or what the economic position is a great idea. So munis are a great idea right now. Using, direct indexing where you have portfolios that are trying to minimize tax impact by, sort of buying and selling and matching those off throughout the year in order to minimize gains going forward. I think that's also a great way to help clients get a little bit more alpha in their portfolio. And the last thing I would say too is there's going to potentially be some tax changes, sunsetting of some tax laws that occurred a few years ago. And if you have an estate or net worth over $5, $6, $7 million, you might want to start thinking about speaking to your estate planning attorney about some trust implementation.
And to bring it back to the equity market, since I'm a big stocks guy, that's what I do.
Yep.
I'm like talking about tax and trust implications, and you're like equities, man.
Like, what about the lines that go up and down? You talk about taking a measured approach. Are there industries, sectors that you see more kind of fairly valued, or at least more of a better buying opportunity instead of chasing some of those growthy tech names?
Yeah, I do. I think basically anytime you look at different companies, growth at a reasonable price. So you want to look at the valuations of a company and see whether or not, it's overpriced for what they're earning at the moment. But we like healthcare. We like financials. We like, consumer. So there's other areas that you can look at. I would say dividend paying, growth at a reasonable price, and income producing. It's interesting. I know you like stocks, and we all do. We love equities. We're owners, right? Not loaners. But at the end of the day, there could be some really interesting opportunities in the fixed income market as well.
All right.
Don't dismiss that.
Don't discount that. All right, Kathy, thanks a lot. We really appreciate it. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management, with her outlook on the markets. All right, coming up, this is Bailey Lipschultz's favorite topic. Paramount. Paramount. He's really over it. But the stock is down by about 5%. The stock falls as the Seagram heir, Edgar Bronfman Jr., drops out of the bidding war. Apparently, it was just too tight of a process for him to get all his ducks in a row. We're going to break that down with Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media. Also, then, what does Paramount actually wind up doing with itself? There were some reports yesterday that potentially some TV stations under Paramount could be up for sale. We'll break all of that down with Geetha. Broader market check here. You're doing equities, whole lot of nothing. We do some world and national news for you, and for that, we go to Michael Barr. Michael Barr, over to you.
Thank you very much, Alex, Bailey, John. The Israeli military says it's rescued an Arab citizen of Israel who was among scores of people abducted in Hamas's October 7th attack. The military says 52-year-old Cade Farhan Al-Qadi was freed. Israel described it as a complex operation in the southern Gaza Strip. Special counsel Jack Smith is appealing last month's decision by a judge to dismiss the classified documents case against former President Trump. Judge Eileen Cannon ruled that Smith's appointment violated the Constitution because he was not confirmed by the Senate the way the U.S. attorneys are. Former federal prosecutor Lori Levinson says the push here is whether Smith can keep prosecuting the case.
The 11th Circuit will get the first crack at deciding whether Jack Smith can stay on as special counsel, but it's quite possible that this case will end up in the Supreme Court. Meanwhile, the case against Trump regarding the classified documents has been dismissed, not because there's a finding that he's innocent, but because there was a successful challenge as to how Jack Smith, the special counsel, was appointed.
Former federal prosecutor Lori Levinson. Smith's appeal points to a long tradition of outside attorneys taking on cases within the Justice Department, describing Cannon's ruling as strained and nonsensical. A federal judge in Texas has issued a temporary pause on the Biden administration's new protections that would allow immigrant spouses of U.S. citizens a path to citizenship. Millions of people are enduring dangerous heat and humidity in the Midwest. Dr. Darian Sutton says people should drink more water.
It takes energy to cool your houses down during the summertime. It takes energy to keep your body cool during the summer. That puts stress on our heart, our lungs, our kidneys, and increases our risk.
Dr. Sutton spoke to ABC. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks fluctuating. We are near all-time highs. Remember, the Dow closed at a record high yesterday. Right now, the Dow Jones Industrial Average 10 points lower, 41,232 on the index. The S&P 500 is up 7 points. That's a rise of 0.1%, 56.24 on the index. And the NASDAQ 100 right now up 58 points. That's a rise of 0.3%. And the smaller caps Russell 2000 index, that is down about 0.6%. Among some of the individual movers, that is, Super Microcomputer falling. Hindenburg Research says it's short of the company as Super Microcomputer shares down 1.8%. And also on the move today, Paramount Global shares, they are down 5.25%. David Ellison, Skydance Media, set to become the new owner of Paramount Global. Seagram heir Edgar Bronfman Jr. dropping out, so it ends the bidding war. Affordable housing remains an issue. CoreLogic says home prices in the U.S. rose just 5.4% in June from a year earlier. That's faster than the overall inflation rate still. And as we look at yields, two-year yield unchanged, 393. The 10-year right now up 3 basis points, and that is at 384. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, your Bloomberg Business Flash. Bailey and Alex.
Thank you so much, John Tucker. I'm Alex Steele alongside Bailey Lipschultz. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. And one of the hardest working ones is Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media. And of course, the news, Skydance is set to seal the deal for Paramount after Bronfman dropped out. Geetha, can you now retire the spreadsheet with the bajillion lists of like who's going to buy and what price and what money goes where?
Yeah, I don't know, Alex. This one's been a tough one, right? It's not over until it's over. But yeah, you're absolutely right. I think Skydance does seem to be, the only bidding party here for Paramount. And the Edgar Bronfman bid is, and we were talking about this last week, Alex. It was really a little bit of a head scratcher because they made that 11th hour move. He cobbled together something like 20 outside investors, and then when kind of push came to shove, he really couldn't find the equity financing required to back his $6 billion offer.
Am I reading too much into it to question why the 11th hour offer? Like if it seemed like
there wasn't enough time
to do it earlier? There wasn't enough time and you're trying to find people and get funding, it kind of, I don't know.
Yeah, I think, a couple of different things. Maybe he had difficulty kind of finding all the different parties interested. Obviously, he didn't, there was a go shop period. That was a 45-day period, and he literally submitted it on August 20th, and August 21st was the end of that 45-day go shop period. One could argue that maybe he didn't want to, kind of show his hand too early, so that there, would be other parties kind of jumping in. But at the end of the day, he obviously does not have the financial firepower of the Ellison family. And that's something I think investors are going to have to come to terms with.
So, all right, let's just walk it forward. You get Skydance, gets Paramount, et cetera. There were some reports yesterday that maybe some of the TV networks, I'm assuming local, would be spun off or sold, et cetera. What are we expecting of that sort to unfold?
Yeah, so Alex, they do have, so they right now have 3 co-CEOs, and this kind of structure, this temporary structure is going to continue till the Skydance deal closes, which might happen sometime towards the latter half of 2025. Until then, what they're really trying to do is number one is make streaming profitable. They already did do that in the second quarter. So they're really kind of cutting down on marketing spend. They're cutting down on content expenses. They're doing everything they can to right the ship. They're also kind of trying to undertake cost cuts across the whole enterprise and get rid of non-core assets. So the news that we got yesterday about them looking to divest some of their local TV stations exactly kind of goes to that strategy. They could potentially end up with about $500 million, about $500 million or $1 billion for those, TV stations. Again, that's going to help them pay down debt. And debt has been a huge problem for Paramount. They have almost about $14.5 billion in debt. And that has really kind of complicated the whole story because they have low EBITDA, low free cash flow, and then very high debt.
And what does the path forward look like? I'm just looking through your latest note, kind of looking at strengthening the balance sheet. To your point, more than $14.5 billion in debt. Market cap is $7.6 billion, so you never really want to see numbers that stretched. But what does Ellison's deep pockets bring to the table? Like, how does this potentially revamp Paramount, if at all?
Absolutely. That's a great point, Bailey. So I think the main reason that Ellison has been chasing after Paramount for all these months is really his interest in kind of getting his hands on the studio. So he does have a long history with Paramount. They have, the Ellisons have been a co-financer on many of the Paramount TV and film projects, most notably a lot of the Tom Cruise movies. So they do kind of know how, that business works. They have a lot of expertise. So they are going to kind of double down on the Paramount studio business. The theatrical business is rebounding nicely, so I think it does make sense for them. And historically, if you just look at Paramount, this is, the studio has always kind of been a stepchild. So it's nice that it's going to now come into focus. And then along with that, you have almost 1,000-person animation team that Skydance is going to bring to Paramount. So really kind of doubling down on the animation business. And this is important because we see studios kind of going deeper and deeper into animation. Animation is one of the most profitable genres across the whole movie space. So it makes a lot of sense for them to get into that in a bigger way because they can really kind of enhance the profitability of the studio business as a whole.
Yeah, I mean, I think it would probably be, I'm just looking to see which, they did Charlotte's Web. What other big ones? I don't know. I usually go to Disney for that stuff, but fair enough. Okay, I'm going to go to the topic that Bailey is really pumped to talk about, and that is podcasting monetization in a big, big way. So apparently Travis and Jason Kelce, brothers, NFL stars, have signed a 3-year deal with Amazon's Wondery for their podcast New Heights, $100 million. This is one of just many that we've seen in the last few weeks of superstars getting paid a lot of money for their podcast. Actually, not even superstars. These guys are superstars, but some of them aren't.
Yeah.
That are getting paid a lot here. Well, can you just give me your read on this?
Yes, podcasting is this next big growth area, Alex. So right now, it's still pretty small potatoes. If you just look at podcast advertising in the United States, it's about $2.5 billion right now. But what they're really going after is the $20 billion that traditional radio actually attracts. And so just as we're seeing the shift in the video space from linear TV to what we call connected TV or streaming platforms, we're also seeing kind of the movement of ad dollars, again, from radio to kind of digital audio, and more importantly, podcasts. And of course, as in the video space, content is king. So you have something that's a little bit of a differentiator. All of these big tech platforms absolutely want to go after it. And for New Heights, I mean, they had the deal with Apple. They had about 2 million listeners there that showed up for those podcasts. But Amazon obviously recognizing the value of that and kind of snatched it away. Big deal, 100 million.
Well, Geetha, you mentioned kind of TV rights. We only have about 40 seconds here. Resetting the bar. So $100 million for Jason and Travis Kelce, $100 million to Alex Cooper's Call Her Daddy podcast. Is this resetting the market? Is a $100 million deal just going to be something that podcasters now walk in the door expecting?
I think so. I think for all of these big names, and as long as they show that they have, ultimately what these podcast platforms are really paying for, Bailey, is engagement with audience. If you have a loyal following, that's everything. That means everything. And obviously, Jason and Travis Kelce have that. Alex Cooper has that. Joe Rogan has that. And so the tech platforms are willing to pay up for that.
I just want to point out that Bloomberg Intelligence has a podcast on the weekends. You guys should definitely watch it or listen to it. Selflessly promote.
Well worth $100 million.
Yes, if you listen, we'll make more money. So do that. All right, Geetha, thanks a lot. I appreciate it. Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media on the Skydance deal, as well as the profitability of podcasting. Are you a podcast listener? You are, aren't you?
I'm not a podcast listener, but that's what I was going to say to Geetha's point. I don't listen to these, but I am on X and other social medias. Mm-hmm. So when the Kelce brothers will have a clip that goes viral, I see that because it gets promoted, and I watch the 20 seconds and kind of get caught up.
So it's both. Like you have to have both.
Yeah.
Interesting. All right. Well, coming up, we got a lot more. We're going to talk about housing. I want to see how the Lipschultz house is going there. We're going to talk about DIY projects with John Tucker. We got a lot going on. All right. This is Bloomberg Markets turning a little bit positive. on this Tuesday. This is Bloomberg. Get the
company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Look at your company news. Mark Zuckerberg says the White House pressured Meta platforms to pull COVID posts. CEO Zuckerberg alleging that Facebook was pressured by the U.S. government to censor content related to COVID-19 during the pandemic. He says he also regrets the company's decision to agree to the demands. Zuckerberg writing in a letter to the Committee on the Judiciary, the House, that in 2021, senior officials from the Biden administration, including the White House, repeatedly pressured his teams for months to censor certain COVID-19 content, including what he says was humor and satire. During the pandemic, Facebook officials did draw ire from the critics of lockdowns, vaccines, and masking mandates because it removed certain posts saying they contained misinformation related to the virus or otherwise went against its policies. Apple is growing and growing in India. Yeah, you know, much is made about Apple's presence in China, but Apple's ecosystem in India expected to spawn as many as 600,000 jobs by the end of this fiscal year. According to the Economic Times, this reflects the runaway expansion in operations of the iPhone maker in the country and its efforts to diversify production away from China. And finally, Amazon aiming to launch a delayed AI Alexa subscription in October. So it works this way. Alexa, here's my credit card information. Yeah, this is according to an internal document obtained by the Washington Post as they face new competition from artificial intelligence voice assistants. Access to the upgraded version of the assistant will require a paid subscription. True story. My mother used to get jealous of my father, thinking he was spending too much time with Alexa. is.
Really?
That's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. I'm Alex Steele alongside Bailey Lipschultz. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Also check us out on YouTube as well. We bring you all the top news in business, economic, and finance, plus world and national news. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex. Bailey. John, the Israeli military says it rescued one of the more than 100 hostages still being held captive in Gaza. There aren't many details about the rescue operation, but IDF spokesman Daniel Hagari says the hostage was rescued from a tunnel in Gaza.
During a complex rescue mission, Qaid Farhan al-Qadi from the Bedouin community of Rat, who was kidnapped from Israel by Hamas terrorists during their massacre on October 7th, has been rescued.
IDF spokesman Daniel Hagari says al-Qadi is in good medical condition and has been reunited with his family. Special counsel Jack Smith is asking an appeals court to reinstate his classified documents case against former President Trump less than 3 months before the election. Bloomberg Radio and TV political news director Jody Snyder says the move could have a political impact even if the case doesn't happen before the November election.
This, of course, is something the Harris camp wants to raise. You know, she keeps saying she was a prosecutor, Donald Trump is a criminal, is her line. And anything that points to legal problems for him and the potential for, you know, legal wrangling going forward is probably good for the Harris campaign. The other case they're trying to make.
Bloomberg's Jody Snyder. Brutal heat and high humidity will affect tens of millions across the nation's midsection. It's prompted changes for high school football teams. Some are practicing in the evening, while others have moved practice indoors. And that includes the team at Hoover High School in Iowa. Theo Evans is the head coach.
We have no other option. Well, we're not going to cancel practice. We have something we're preparing for, something we've been working for 3 years. We're going to make it happen somehow, some way.
And much of the East Coast will see 100-degree temperatures later in the week. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg Alex Bailey John.
All right. Thank you so much, Michael Barr. 100-degree heat? No. I have just gotten through the $500 air conditioning bills that I have for my apartment. I know, it's so brutal.
For an apartment?
Yeah, 1,400 square feet.
Man.
Yeah, I know.
You could have gone DIY, though, and got ice in a Home Depot bucket with 2 fans, and maybe that's cheaper. I don't know.
Is that a little bit like what you did in your house?
That's
what we're talking about?
when I interned one of the summers in NYU dorm that did not have AC, you have to do something because it's like 112 degrees. So
like literally, so what do you do?
You get a Home Depot bucket.
Okay.
Put some ice in it. You put one fan that sits in the bucket so it blows up the cool air. And then you have another fan sitting behind it that blows the cool air at you.
It's actually pretty genius.
JT, have you done something like that?
Why don't you just stick an air conditioner in the window?
You can't, because you can't.
Also, you're not going to buy an air conditioner and then for a dorm at NYU for 3 months. Wow, that's genius.
Get out the door for $50. Yeah. I mean, you got to refill the ice. That's the only issue is finding ice.
That's, you know, that's a lot cheaper than $500 for a month there.
And then the ice melts.
Really fast. Speaking of homes, sorta, here was an article that JT said it was boring, but I found it interesting. Home price gains in the U.S., they slowed in June. So prices are up by 5.4% versus an annual increase of 5.9% in May. My question, though, is, so home prices are slowing. Okay, that's good for buyers. But then the second mortgage rates are lower. Aren't we going to have like a rush of buyers coming in, and all of a sudden that's going to jack up home prices and lessen affordability?
That's what I would think. As a new home owner, going on, I think, a year like tomorrow, I can't wait to refinance. But I don't know if you've been waiting to sell, what that looks like, because the whole concern is supply demand. If you have a 2% rate, you're not going to sell anytime soon. But if you're a buyer, to your point, they should be coming out of the woodwork to pounce on the
right, and then that like cancels out affordability. Yeah. What's your refi hurdle? So Paul's is, I think, below 6%, his refi hurdle.
I'm right around there, yeah.
Below 5%.
I'm 7 1/8, so at least 1 point.
Ooh, that hurts. That hurts. Yeah. So if I say 2.75% for me, that makes you feel bad?
Oh my gosh, I'm gonna lay down and cry.
You just love saying it.
I do love saying it. I know, I'm such a jerk. All right, more coming up.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday, everybody. I'm Alex Steele alongside Bailey Lipschultz. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics through our lens of our Bloomberg Intelligence folks, and we get a lot of them in this hour. Michael Shaw will be joining us in just a moment, Bloomberg Intelligence Senior Pharma and Biotech Analyst. Brooke Sutherland is also joining us. She's the Boston Bureau Chief. There's a great story on real estate and cities and office values, so we're going to break that down. It's the big take story of today. And then also Rania Sedholm is managing partner at Sedholm Law Group. We're going to talk about the struggle of luxury brands. Bailey, thanks for joining.
Of course, I'm excited for the second hour. Happy NVIDIA Eve.
Happy NVIDIA Eve. Yeah, happy Friday.
Happy Friday to you. You're going to go be at the U.S. Open. It's fun.
I'm definitely going to be paying attention to NVIDIA tomorrow. It's not happening. All right, let's get you kicked off here with a business flash with John Tucker.
All right, Bailey and Alex, the major stock averages hovering near records. Not a whole lot of conviction as volumes are very low right now. Most active is shares of, yes, NVIDIA. As we await the earnings report after the close of regular trading tomorrow, shares of NVIDIA right now, they are up 1.5%. U.S. consumer confidence rising to a 6-month high in August. More upbeat views of the economy and inflation offsetting some less than optimistic outlooks about the labor market at this point. Some of the individual shares on the move, Eli Lilly now selling vials of its blockbuster weight loss drug Zepbound to patients for as little as $3.99 a month. It's trying to overcome supply shortages of some of the wildly popular shots. Shares of Lilly right now up 1.3%. Overall, the S&P 500, you have about 6 of the 11 major industry groups. They are higher right now, being led by information technology. S&P 500, 10 points higher. That's up 0.2%. 5627 on the index. The Dow Jones Industrial Average kind of sort of adding to its record close yesterday, right now up 2 points. The NASDAQ 100, 87 points higher. That is up 0.5%. As far as yields, the 2-year unchanged, 393. The 10-year yield right now 3 basis points higher. That is at 384. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Bailey and Alex.
Thank you so much, John Tucker. So a little bit of change after the consumer confidence data. We're now flat on that 2-year yield and a little bit of buying within the equity market. There are some individual movers, though, we want to get to. Bloomberg equities reporter Norma Linda is back with us. First up, got to mention Paramount.
We have to start with Paramount.
So stoked.
Yeah.
Please tell me all the details about it. Break it down.
As if you haven't heard it 17 different times.
I would love for you to break down individually what this deal looks like and how it compares to the Bronfman offer.
Sure.
Imagine.
She's
well,
like,
Paramount is the biggest decliner in the S&P 500 right now. And this is, of course, coming off of that news that Bronfman is dropping out and ending that bidding war that everyone's really been watching, as everyone's really been vying for Paramount here. And we are seeing that the deal should be complete in the first half of 2025, especially as Bronfman slid out of this whole conversation about whether or not they'll be taking on Paramount just yesterday. So it is ending its go shop period that allowed it to look for other bidders. We're seeing shares of Paramount down as much as 6%. This is the worst day since June on an intraday level. And we've got shares down about 28% year to date for Paramount here.
I just want to say Geetha's note says Paramount M&A twists and turns brings it back to Skydance. And Alex, you're a big Marvel fan, right?
Yeah, I am.
It kind of reminds me of, Thanos or Thanos. You couldn't live with your own failure. Where did that bring you? But
yeah, but you know that Paramount doesn't do the Marvel stuff?
No, I know, but it's a quote back to you.
Yeah, I appreciate that. I just want to be clear that, like,
I'm not mixing it up.
Separation there.
Yeah, when people say that, like, Superman is in the Marvel universe, it's upsetting. It's upsetting. It's upsetting. They're DC, and they're very different, and it does hurt my soul.
I mean, Marvel's just so much better.
Thanks for seeing me. I mean, the whole thing.
100%.
Even though they had some missteps and stuff, but Deadpool's bringing it home. All right, Supermicro.
Supermicro, got to get back on topic because I'm sitting here thinking about Marvel movies right now. Supermicro is tumbling as much as 8.7%, and this is after Hindenburg has taken an aim with a short report, and we're still waiting to hear back from Supermicro here, but Hindenburg is saying that there's some glaring accounting red flags from the company in undisclosed related party transactions, some customer issues, as well as sanctions and export control failures. But I mean, this seems like it's really just water off of Supermicro's back, considering the stock is up nearly 90% this year. It's one of the bigger gainers when we're looking at tech stocks and we're really thinking about the AI outlook. A lot of investors are really behind this stock.
Yeah, NVIDIA up 1.7%, Supermicro now only down 1.7%, so really recouping a lot of those losses. Nora, my favorite IPO to talk about from the last 18 months at this point, Kava.
Yes, you are the expert on this. Do you like the food there?
I've eaten it one time, and I think it's 3 times the price to my normal halal cart for kind of like the same thing.
We're here. Same page.
I've never tried it, but
you need to check it out.
But the stock is unbelievable. I talked to the CEO on TV on Friday, and it was just really hard to find something negative to really drill down on at the end of the day.
I mean, on a year-to-date level, we're seeing shares up 177%. So we are seeing shares of Kava down today. This is after the company's largest individual shareholder and a group of execs filed to sell shares. But I mean, when you think about that rally for Kava specifically, I mean, they just raised their full year outlook with those beating expectations, and sales at locations are open for at least a year, just jumped almost 15%. That's exceeding analysts here. This company is really on a roll.
Brett Schulman, Alex, you interviewed him, sold 201,000 shares for $25 million.
Hey,
nice return. Can't knock it though. Up more than 400% from IPO price. So.
Yeah, I mean, he did stay with it up for a little bit. I was just really impressed by their lack of raising prices. Actually, like they raised it some, but not the same as inflation. That was really impressive.
And they're expanding their options in terms of proteins. I think it's just a master in marketing. I remember getting my haircut like 2 days after they went public, and one of the barbers was like, "Oh, have you had kava?" And the guy's like, "No, I don't know what that is." He's like, "Well, it's Mediterranean Chipotle." So then everyone calls it Mediterranean Chipotle. Chipotle's been an unreal stock. Everyone loves Chipotle. As a big fan, so.
Fair enough, fair enough. All right, Norm, thanks a lot. Really appreciate it. Norma Linda joining us from Bloomberg News. One of the top stories of the day is also Eli Lilly now selling some Zepbound vials at a 50% discount to the shots. Michael Shaw is Bloomberg Intelligence Senior Pharma Biotech Analyst. Can we just help me understand why this is easier for Eli Lilly to produce than the actual shots?
Absolutely. So I mean, the announcement today doesn't really come as a surprise on the back of the tight supply. So yeah, they're providing a vial formulation. It's something that they've talked about for a while now on their calls. Now the reason why these are easier to produce is the fill and finish capacity. So the capacity needed to actually put the drug in the pens, and the capacity needed to manufacture the pens of the subcutaneous injection. So overall, I think the move is positive for Lilly. Clearly broadens access or patients' access to Zepbound, and also from compounding pharmacy standpoint, the fact that it improves supply means it could possibly combat competition from companies such as Hims and Hers.
Yeah, Lilly not so subtly saying that they want to aim to protect patients from, quote, counterfeit, fake, unsafe, or untested knockoffs. So how does that impact kind of the business and demand if we're seeing a cheaper version being sold and maybe trying to court some of those Hims and Hers GLP-1 users? How does that impact kind of the total addressable market and expectations for sales of Zepbound?
Well, I think if there's if there's a branded vial formulation out there, and there's obviously guarantees around kind of purity, etc., I think that's going to be the preferred choice. The fact that you're introducing these vials into the market would suggest that some of that supply burden and supply shortage, which is needed for a compounding pharmacy to produce a drug that is on patent, some of that will be alleviated there. So that's kind of why we think it's positive for Lilly. As to whether companies like Hims and Hers will continue producing their versions of the GLP-1s, I mean, that remains to be seen. But I imagine if they do, Lilly would probably challenge it.
When people then do their own shots, like administer it, like is there a risk in that? Like what kind of uptake are we expecting from that? Because I would be scared to do it, but maybe that's just me.
I mean, I think judging by what we saw for uptake of these compounded drugs, there's clearly a appetite for injectable therapy, injections. Now, we look to the diabetes market. Some of the insulins used to be injections. So, I mean, I think it's not. I mean, there's clearly kind of an increased kind of dosing burden associated with these injections. So they're probably not going to be suitable for all, but I think there is going to be an appetite for it.
What does this mean for the competitive landscape? So you have Lilly, you have Novo. To your point, you have Hims and Hers. Like, is this going to create a pricing war, or am I reading too much into that?
No, I mean, when we look at the the headline said 50%, discount. But we need to remember that, on a net price basis, so, after taking account all the rebates and discounts, the pricing is probably, fairly similar to the current net prices that we're seeing now. At the moment, it's an underpenetrated market. There's massive demand out there. There's tight supply. So I don't think it's going to, change too much in terms of the dynamics between, Novo and Lilly. I think prescribing decisions are, less about kind of the profiles of the drug at the moment and more about, what is insured, what can people get their hands on.
Yeah.
So near term, I don't see, that changing. From a Lilly perspective, as they ramp up supply over the midterm of their, their pens, you could potentially see, patients switching from the injectable onto the pen as and when that supply comes on board.
No, fair enough. All right, Michael, thanks a lot. Really appreciate it. Michael Shaw joining us, Bloomberg Intelligence Senior Pharma Biotech Analyst. Let's get to actually some big news first for our New England listeners, guys. You got Bloomberg 1061 and 1330 moving up to 92.9 FM. Now, starting September 3rd, listen to Bloomberg Radio in and around Boston on 92.9 FM. It is your news source for Bloomberg business news from the financial center of New England. Bloomberg Radio moving to 929 FM at noon the day after Labor Day. And for that, we want to go to our Boston bureau chief. See how we did that there? Brooke Sutherland is joining us. On today's Big Take, it is a wonderful piece. You should definitely check it out. The Big Take is entitled "A $557 Billion Drop in Office Values Eclipses Rival of Cities." And the idea is that we can all be obsessed by commercial real estate issues, particularly in major cities like Midtown New York, but there are other neighborhoods that are holding up really quite well and actually thriving at this point. Brooke joins us now. Brooke, great to see you. Walk us through the Big Take.
Sure. I mean, I think what's really interesting about this is that office all tends to kind of get put in one bucket. And when we talk about the trends that we're seeing in office real estate in particular, the picture does not look great. It looks rather depressing. But I think that, what's interesting about this is if you focus actually on specific buildings and really specific neighborhoods within some of these major cities, you start to see some real discrepancies. And, some neighborhoods are actually doing quite well. We've seen an uptick in return to office rates, and those buildings that are higher tier with more amenities are able to charge more in rent. They're able to fill their spaces much easier. And, I think that's just a really interesting aspect of this office recovery to pay attention to, is that not everything is really in the same condition here.
Well, I think that's what's really interesting. So it's not necessarily LA versus Seattle versus Boston versus New York. You guys really dive into a few blocks away. It's a very different picture. With that in mind, you mentioned kind of a nod to the so-called K-shaped recovery. What kind of is driving the differences? Is it businesses? Is it kind of just strictly locations? Is it typically the people who are living or working in those areas?
I mean, I think it's a little bit of all of the above, but I mean, just speaking on Boston in particular, if you look at sort of the downtown financial district that's home to, many of the old line Boston institutions, companies like Fidelity, the Federal Reserve Bank of Boston, you've seen a much slower recovery there. If you just walk around, it's very obvious that there's a lot of empty office buildings. There's a lot of signs up advertising retail space, office space, and just not quite as many people out and about on the streets. A lot of the lunch places, for example, have closed down, and you really sort of just have the chain restaurants that are holding up and doing well. But then you just take a short walk over to the Seaport District, which is much newer. And a lot of those buildings, have just been built in the past 10, 15 years. And they're, just in better shape, and there's a lot more traffic there, and it's just a place that people want to be. And I think that that's really kind of what's explaining that is obviously, if you're going to the seaport or you're going to the financial district, you're still commuting. But as often, companies think about where they want to have their office. I think being in these higher traffic areas with better amenities that workers want to be able to access is really important.
Well, then to that point, I wondered about the office buildings there, though. Are they new? Are they cooler? Are they, like, when I talk to some commercial real estate guys here in New York, they're like, look, the newer building you have, but the newer amenity is, the easier it's going to be to fill. The older, you got to retrofit it, and if not, it's a lot harder to fill. Is that the same idea, say, Seaport versus the financial district in Boston?
I think it's a similar idea, although I will say, like the Class A buildings in the financial district are obviously doing better than the older Class B buildings in the same neighborhood. And so you still do have that discrepancy within neighborhoods. But I think what's really interesting is that if you then sort of compare between the neighborhoods, you also see a divergence. So it's not just, that Class A across the city is doing better, although it is, but you really dig into kind of the nitty-gritty detail on specific neighborhoods. And you do see that within these specific neighborhoods, even the higher tier buildings are outperforming other higher tier buildings. And I think that just really comes down to, what is the environment like? And if you can go to, more retail shops on your lunch break, and you have more options of places to eat, and maybe in terms of, going out after work, you just have more availability. I think that all sort of factors into it. And, obviously this is sort of a sliding scale. And when you have a concentration of companies and offices in one place, that does sort of deepen the hole, so to speak, in some of these other areas.
And Brooke, we have about 30 seconds. Who are the big winners or losers? Are we looking at Blackstone or foreign investors? Like, are there any kind of trends that stand out?
I do think, that commercial real estate investors are sort of waking up to this idea that there are pockets of opportunities in these cities, and that it's not necessarily correct to paint them with broad brush and to look at it like Boston versus New York or Boston versus San Francisco, that you really have to be neighborhood specific and building specific. And I do think that there are companies here that are, willing to look at some of these opportunities and think about them differently, even though, the broader office market has obviously been in a pretty protracted slump here.
All right, Brooke, always a pleasure. Lovely to chat with you. Brooke Sutherland, she is Boston's bureau chief, joining us on The Big Take. You can check it out on the terminal. Also, it's a podcast. You can check it out at Bloomberg/podcast/Big Take. All right, coming up, we're going to talk about broader fixed income, right? We got a lot of auctions coming out later today. We also have the jobs data next Friday. Plus, you have Supermicro. As Bailey was pointing out, it's one of the top performing stocks within the S&P, but it is getting hit hard today on a Hindenburg report. We're going to kind of walk through that with Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst. So stay with us for that. On a day where the market's not doing that much, you have a volume still quite light. The NASDAQ is up 0.2.